Paramount, Fox, you could go down the list. Literally everyone but Disney and Comcast, they don't even add up to Netflix.
I was looking at the churn rate of some of the data about when subscribers are just like, I have too many of these streaming platforms, I need to get rid of something. Everyone else has averaged about 5%. Netflix is at 2%. So has that become the base for customers? Like Netflix is my base and then potentially I'll add on something else?
I think so. That's the advantage of a really deep library. I mean, there is always something on, as we were talking about before. Like, I can't even remember what I saw yesterday because I just plowed through something. And there's so much content. And that's a good thing, as long as they can actually manage the economics of it and do it at a profit margin. Keeping to investing towards scale is what matters most.
And Brian, it seems that everyone's got something to say about Bob Iger and the job he's doing over at Disney. Has anyone offered a solution? What is the solution?
I've not heard one. I think that they do seem a bit adrift, right? If there was a lot of strategic clarity going into his first retirement, they knew what they were doing, they had a very clear plan, and now it's kind of all over the place for the last year and a bit. He's floating ideas left, right, and center. And I do wonder if it's because he has to reassemble his team, a strategic advisory inside of the company, and that's just going to take a bit of time.
We've been asking about the future of ESPN for something like a decade now.
Yeah.
What is the future of ESPN?
I think it's fine for the near term. I think the problem, and I worry about this with sports in general, is that one of the great appeals of sports is that everyone watches a little bit of sports, at least. Then you've got a large number still of hardcore consumers who will pay a lot of money for it. But the business model only works if you get everyone watching a little bit of it too. The advertising money goes in and really makes the economics work, only because of the breadth and the reach. But as we get to a world where the primary way to access sports content will be on your traditional pay TV service, well, most people who don't want sports, don't want to pay for it directly, will not have pay TV services within a few years. And they're not going to pay an a la carte $30 or $40 a month for an ESPN streaming service either. So I think sports is in a really difficult place when you start to look out 5 years from now.
Well, that means that cable companies are in a very bad place when you look out that far. And I am wondering, how far are we from the time when streaming takes over the sports channels, the sports teams, the sports viewing, and basically is the death knell for the cable?
Cable's in a great place because they're ultimately a data business. They're internet services businesses.
Everything's a data business.
No, but they really are, because you primarily choose your cable operator now because you want the high-speed data service.
Oh.
You pay up for that. We all do.
Brian, it's good to see you. Brian Weiser of Madison and Wool. I'm with Brian on the sporting stuff. Sports rights have got so expensive, and we've got to this point where they don't really know what to do with them. So you take a football game and you bury it on Peacock, and you hope that it sticks, and you hope people start signing up. The strategy around sports is not as obvious as it once was, and I'm not sure if the numbers, the profits, make as much sense as they used to.
And that's the reason why some people are saying the new model looks like the old model, which is you bundle it together and you have an offering. And the question is, who's going to win from that? What I find interesting is so many sports teams are just going direct. They're saying, you know what, we want our private capital, we want our intellectual capital, our intellectual property. So, you know what, we're just going to get the profits directly and you can invest in us.
The Netflix results coming up a little bit later on this afternoon. Let's take a look at some of the other stories making headlines this morning. Let's catch up with Yahira Akers with your Bloomberg Brief. Morning, Yahira.
Good morning, John. Goldman Sachs chief economist Jan Hatzius weighing in on the Fed's path and the state of the U.S. economy.
The Fed is on its way to achieving the soft landing. Obviously, no guarantees, but I like what I'm seeing.
Hatzius also saying Goldman maintains a base case for a March rate cut, noting it would be consistent with the trajectory of consumer prices, alongside Chair Powell's comments that the central bank would like to cut before inflation returns to 2%. Citigroup says it's cutting bonuses in its investment banking business. The bank is chopping payouts by 15 to 20% this year, according to the Financial News. The reductions coming after Citi posted an 11% decline in deal-making fees for 2023. The SEC confirming a hacker hijacked its Twitter account earlier this month and made a fake post about the approval of spot Bitcoin ETFs. The agency saying an unidentified person changed the password after gaining control of an employee's phone number. The fake post caused a brief surge in the price of the world's biggest cryptocurrency. The SEC approved almost a dozen spot Bitcoin ETFs the following day. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate the update. Up next on the program, China hoping to spark an equity market bounce after a rough start to 2024.
We pulled our clients out of China because we just think it's not a place that you can, as a fiduciary, that you can put client capital.
That's next on the program. You're watching Bloomberg Surveillance live from New York City this morning. Good morning.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Later got asked to be the head of USAID.
I got that job when I was 36 years old.
36 years old, you're running USAID. How many employees does it have?
We had 11,000.
And did you feel qualified to run something that big?
I did until, the work started.
DOJ or other authorities
could face bigger challenges next.
Was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City this morning. Good morning to you all. Here's the price action on the S&P 500. 3 days of gains on the S&P, the longest winning streak of the year so far. Another record close at a close yesterday. This morning, totally unchanged. Under surveillance this morning, China hoping to spark an equity market bounce after a rough start to 2024.
The sentiment is so bad, I would have to expect that there's an opportunity somewhere, but we pulled our clients out of China because we just think it's not a place that you can, as a fiduciary, that you can put client capital.
You think it's uninvestable?
Essentially.
Uninvestable. Alicia Levine of BNY Mellon Wealth Management speaking to us yesterday. Today, China drawing up a $278 billion rescue package to backstop, Lisa, the country's stock market.
And really, if people are wondering what they're trying to achieve, is it just a temporary boost to valuations or something longer term? Kevin Sneeder, who's head of Asia Pacific, ex-Japan for Goldman Sachs, was speaking on Bloomberg Television, and he said the question when you look at this package or any other set of actions is how does it address that? How does it change the sentiment? Does it give people reasons to believe in the future of the economy in a positive way? Part of the challenge is whether the words will be met with action. That's repeatedly been the issue. John, when we take a look at the different measures, the piecemeal measures that the Chinese authorities have come up with, it doesn't seem like they're convicted to do something that is holistic and give people comfort.
It feels like they've been doing this for the best part of 10 years now. Just tweaks at the end. We've joked about the plunge protection team coming together. I remember 2015, 2016, when big funds in China on the mainland were told they couldn't sell. Not short, couldn't sell stocks. That's how long we've been doing this for now.
And that's different than some of the other measures that were announced in other capitalistic economies. I'm thinking of the U.S. that were not so wholesale banning activity. Here's the question. Do you see a real commitment to bringing back foreign direct investment by the Chinese authorities? We saw the biggest coalition of Chinese authorities come to Davos since 2017, trying to talk with people. But there was resignation that things aren't going to change materially, that the U.S.-Chinese relationship is fracturing. And with that kind of backdrop, how do people get that confidence that they can get their money out if they put it in?
Let's catch up with Enda Curran, the Bloomberg Global Economy correspondent down in Washington. Enda, your view on this, just what is the strategy here from Chinese authorities?
I think it clearly speaks to a new sense of urgency among the authorities
John, you had Premier Li Qiang the other night making the point that they have to respond with forceful measures. That means now the concerns over where the stock market has gone is at the very top of government. Worth bearing in mind, we're only 3 odd weeks away from Chinese New Year. When you consider the retail investor component of the stock market, they don't really want to have another dampener on consumer sentiment ahead of the all-important holiday season. The question, though, is, will this mechanism work? You know, Lisa was talking there about 2015, that had some impact over the summer months, but when they pulled back from the market, it went back into the sell-off mode. A lot of people are questioning whether this kind of rescue that they're talking about this time around would be nothing more than a sugar hit. It won't change the fundamentals. We know what they are. Property market's in a slump. FDI, foreign investment, is in a slump. Consumer sentiment isn't great. The piecemeal approach hasn't turned things around, and the question is whether or not this stock market intervention will be enough to do that.
And what's the goal here? Is this directed at foreign investors, or is this really directed at trying to drum up domestic sentiment at a time where people haven't been spending, people haven't been borrowing, people haven't been deploying their cash that they've been hoarding?
Definitely a little bit of both. And the domestic story, there's no doubt they don't want the stock market in a heap just before the all-important Chinese New Year holidays, as I mentioned there, given the retail investor component. And of course, we know corporate profits are being squeezed. There's a sense of overall gloom on the Chinese economy. So there is a domestic angle. But equally, though, there is a signal to the world here, especially with Premier Li Qiang. He's been touring the world, and you saw him in Western Europe last week, making this point that China's open for business. Come and invest with us. Come and do business. But of course, when you have this image of the stock market cratering the way that it is, it just adds to the sense of gloom on China. Uninvestable, as your previous guest said. Companies don't want to invest there anymore. So it's just another effort for China to try and turn around that perception, that image towards China at the moment. But as I say, that's not going to fix the real estate story. It's not going to turn around the foreign investment story. It's not going to turn around the consumer sentiment story. The stock market's only a small part of China's overall economy and financial system anyway. So it's only one piece in an overall jigsaw here.
Jan Hatzius gave an interview with our colleagues in Hong Kong, and he talked about that Chinese authorities are not willing to use a bazooka when it comes to stimulus to shore up this problem. What would a bazooka even look like?
Well, this has been one of the big frustrations, I think, for the rest of the world looking at the China story. As we all know, China was a big disappointment. Last year, it was meant to be the post-COVID zero rebound. Didn't happen. But equally, though, the authorities, very, very disciplined, very restrained when it comes to the amount of support they're willing to put into the economy. They are putting money into the economy. They are spending on infrastructure. They are borrowing. They are certainly putting in some support. But it's not, to your point, this idea of bazooka. And this comes from previous downturns in China where we saw massive whole-scale borrowing spending by the government to try and reflate things. But we know what that legacy has been, of course. It's been a legacy of in some parts, wasteful products or wasteful projects. Of course, it's been a legacy of debt that China's been nursing now since the global financial crisis. That's why they're so reticent, I think, again, to go back with this sort of all-out fiscal approach. But nonetheless, given how negative sentiment continues to be, one would think that the pressure is building on the authorities to do something a bit more meaningful if they do really want to turn the narrative around.
And it just feels desperate. It feels desperate to see reports that they'd be willing to go after the profits, the money offshore from state-owned enterprises, and then recycle that back into the equity market. And you mentioned the fiscal space. Just how much fiscal space do they have if they wanted to do something more?
Not a lot at the local government level. That's where the real debt stress is. The central government, of course, has room to borrow and spend if they wanted to, John. But as I mentioned earlier, they're being pretty disciplined in what they want to do. They have sometimes made in the past reference mistakes made by the West, in particular with, say, QE, for example. They don't want to go down that path. But as I say to you, we're in now second, maybe even arguably the third year of this downturn in China. The authorities won't want that to go on too long. You only have to look what's happening in China's great strategic rival of the US. Stock market's hitting records, economy holding up well. I would say there's pressure on Chinese authorities to do something more over the months ahead.
And I should stress that this, of course, is a package they're considering, according to people familiar with the matter off the back of our reporting. Your best guess would be this package goes through, Ender?
I would say some intervention of some kind is likely, John. They've done it in the past. I don't see why they wouldn't do it again. The question remains whether or not that will be enough to turn things around.
We'll see. And Karen, thank you, sir. Down in Washington on the latest, it's a $278 billion trial balloon, Bramo, to see if this can put a floor under this slumping equity market.
And let's see. I mean, the equities are down some 10% year to date. This is not yet January over. We heard Alicia Levine basically talking about how during a time when they were growing at 6, 7, 8% a year, they still didn't get anything when you came to international investments in China. So why are you going to do that somehow now when they're actually slowing down? I don't totally understand what the motivation is, what the goal is. Is it to actually get foreign direct investment in? Do they actually want international companies competing in a real way? Or do they just want to even things out so that they don't grow as slowly as some people are projecting?
The slump in equity market is a consequence of poor policy. If you're coming in and trying to buy equities using state-owned enterprises' profits offshore and recycling that back into stocks, you're dealing with the symptoms and not the cause. The cause of this is not just the economy, which has slumped and struggled coming out of COVID. It's also the governance issues that Elisa Levine talked about at BNY Mellon. Deal with the causes if you want to see an equity market in the same place where we've got things in America right now.
And seizing offshore money to try to support the equity market might have actually the exact opposite.
Seems bizarre, right?
Right. Well, it's the exact opposite effect, because why would any company have confidence that their money is protected and isn't just going to be reclaimed for government purposes?
A tale of two markets at the moment. US equities at all-time highs. China struggling to stimulate demand in their domestic equity market. Coming up in the next hour on this program, brilliant lineup for you. Thomas Schode, the CEO of KBW, just around the corner, Henrietta Trays of Vader Partners, and Megan Robson of BNP Paribas. From New York City this morning, good morning to you all. You're watching Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Inflation's coming down, the economy is slowing, but in our view, not falling off a cliff.
There could be this stickiness to inflation, which of course makes the Fed's intended path a bit more trying.
If the Fed were to be aggressive in rate cuts, they run the risk of the economy accelerating a bit, and therefore inflation accelerating a bit.
The fact that the Fed is considering rate cuts does introduce a new tail risk, which is the reacceleration risk.
We're chugging along, but we're probably closer to the recession.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market on the S&P positive by not even 0.1%. 3 days of gains on the S&P 500, the longest winning streak of 2024 so far. And over the last 2 days, it's been all-time high, Bramo, after all-time high.
And initially, it was just the big tech, and that was really driving it. It was basically NVIDIA's rally, and everyone else was living in it. But then suddenly, yesterday, we saw small caps start to pick up. You saw even regional banks start to pick up, which I thought was interesting, especially in light of Bob Diamond's comments that we heard yesterday.
The tech earnings coming up a little bit later on this afternoon. We'll talk the financials in just a moment with KBW. The attention, though, from Wall Street to Washington, we're looking over to New Hampshire this morning.
Make or break moment for Nikki Haley. She spends so much time in New Hampshire. If she has a chance in this primary race for president, she has to win New Hampshire, but the polls are showing it's going to be the former president.
Basically, everyone is just girding for a very long general election between Trump and Biden, and everyone's trying to understand when it will matter and when they have to pay attention. And what we heard from a number of executives, October is when they're going to start to pay attention, but there's going to be a lot of noise, and there's going to be real questions about how different the two candidates will be, given that the policies haven't been all that different, at least in trade and international relations.
It's amazing to follow this, that this Republican primary might well be over in 24 hours if you get a similar win for the former president, the one we saw about a week ago.
Because it's something that we haven't seen. It's basically an incumbent running in a primary race. How do you beat an incumbent in your own party to take over the gavel to be leader? It's pretty impossible.
It's going to be really fun. We're all really looking forward to it.
Everyone believes
I am.
Everyone believes you.
I mean, come on. I mean, it's just the truth. Everyone comes in and they're like, really? I mean, at a certain point, how do we game this out in terms of potential surprises? Libby Cantrell, I love her comment from PIMCO. She wrote in a note, no, Jamie Dimon is not going to be president. No, Oprah Winfrey is not going to be a president. And I asked her, I said, really? Why did you put that in as a joke? And she said, literally, the clients that she speaks to are saying to her, come on, isn't it really going to be Jamie Dimon? And she's
Lori
saying,
Calvasina,
no.
RBC, I think nailed it at the start of the year. She said that talking to clients about the political election this year was like staring at the sun. It's like staring at the sun. That's what it felt like for both clients and strategists alike.
So we have a lot of fun, a lot of staring into
Staring
the
at the
sun.
sun for the next 11 months or something like that.
Sounds dangerous.
Let's turn to the price action on the S&P 500, totally unchanged. In the bond market, yields look like this on a 10-year. Lisa, higher by 2 or 3 basis points, 413.20.
Walking back rate cuts, hopes and dreams as people start to look out at better than expected data. One data point after another being better than expected. Curious to see on Friday, PCE, personal spending and income. Could that really change the dial, or are people basically kind of leaning into June as the rate cut and everything else will follow?
So far, so good. The data's been good. Doesn't scream March cut, but we heard from Goldman, maybe March rate cut. We heard from Bank of America, maybe March rate cut. That data's got to turn at some point, though, surely.
Well, here's the frustration that a lot of people have. You're getting better than expected data, but ongoing disinflation. When do we see inflation respond to the fact that we're seeing better than expected economic activity, or are we still living in the post-pandemic reassessment of prices?
Stocks just about unchanged on the S&P 500. Coming up on the program, we'll talk about the all-time highs in the United States, and then China, just a massive struggle considering a rescue package to try and stimulate demand, not in the economy, but for Chinese stocks. Then later on, we'll talk United Airlines, the stock flying high on better than expected earnings and some pushback against Boeing. Then, of course, we'll wrap things up through the hour with a conversation about Nikki Haley and Donald Trump clashing in New Hampshire. We begin with our top story. Stocks at record highs. The banks helping to fuel the rally on the heels of a strong fourth quarter. KBW announcing its top picks for 2024, writing this. We like Goldman, Morgan Stanley, given the backdrop is becoming more favorable for capital markets due to declining pressures on interest rates, a prolonged period of time with recession-level investment banking activity, and the potential for the Basel III endgame to be meaningfully watered down. I'm really pleased to say that with us for the hour, Tom Michaud, the KBW CEO, is with us for the next 60 minutes or so. Tom, good morning.
Good morning. Great to be with you.
Let's get straight into earnings. You've talked about it from 3 perspectives: the industry, the economy, and ultimately going forward from here for the stocks as well? Walk us through the three.
Yeah, I think the industry is a lot like what's been happening across corporate America, which is it's all centered around the COVID and the COVID policy and the policies to defeat COVID. So the hangover for the banking industry was we had a 5.25% interest rate move in 16 months, which is the most in 40 years. And also, just to remind you, is deposits typically grow 5% a year. They grew 38% in the early days of COVID. So the industry is dealing with the unwinding of all this. That means that the industry has had negative operating leverage since its balance sheets have been resetting. There's been no revenue growth in the banking industry. That is going to change, we believe, in June. We believe that we will finally reset the balance sheets. We'll be moving forward if the Fed does, in fact, cut rates. We've got two cuts in our model for the second half of the year. So that will be the first thing. The second thing is we just had earnings reports out, and the stocks rallied 35% from the end of October into the end of the year. The reason for that was it took the worst case off the table. A lot of investors still felt like the worst case scenario was possible. There were lots of questions I was getting from clients about, is this the global financial crisis again? I think we've demonstrated it's not that. And so the industry has survived, is about to re-engage and start to grow again, which we think will start in June. And then the other thing is you talked about the stocks. A lot of talk about how stocks are in the high teens PE ratio and are expensive. Well, not banks and not a lot of small cap banks, that's for sure. They typically trade around 9 times earnings. Some of them have very big dividend yields that they're going to increase. Most of these companies will be buying back stock by the end of the year. And so really, if you were to summarize what we're talking to clients about, 2024 exit velocity. That is a theme that's being talked about a lot, which is we think we'll have an industry that's growing revenues again, slowly. We'll have banks that are raising dividends. We'll have buybacks coming. And if we get a soft landing, that is the Goldilocks scenario. And then we could talk a little bit about credit quality because that's what derails it all.
It shows how low the bar is when it's basically not the financial crisis, let's go. I'm curious, though, when you're talking about the potential to restart and that there isn't a crisis anymore. During March, people were talking about the fact that the FDIC was not insuring beyond a certain level at these small banks, and that became a huge liability. Why wouldn't, in the sign of any distress whatsoever, every investor pull their money as quickly as possible, even faster next time around, to get ahead of any kind of issue? Until that's solved, isn't there basically a cloud hanging over regionals?
That is a great question and a great setup, because I couldn't agree more. I testified in front of Congress last May on that very topic, and I agree. You don't want America to pick their bank based on its size. The implicit guarantee that's been put into these big banks is extraordinary. In an 8-day span of last March, Silicon Valley Bank failed, and the FDIC said the depositors don't get their money back on Friday. They didn't change their mind till Sunday. When Credit Suisse in Europe got in trouble, which was a global SIFI, in the middle of the night on the weekend, the central bank organized a merger with their 100-year competitor across the street, and no depositor was at risk. If you want to see the difference of the implicit guarantee, look at those 8 days and how the two different banks were treated. So the fact of the matter is, small business in America is going to be very unhappy that the FDIC and Congress have not created a modernization of the FDIC insurance fund where small businesses feel comfortable leaving their deposits in banks. And meanwhile, the proposals that we have seen are all about capital and all about issues that had nothing to do with the 3 bank failures. So we're not addressing the key issue, which is deposit insurance modernization.
So let's
and
talk
you said
about
it very well, Lisa.
Let's talk about the consequences. We're focusing on the wrong thing. What are the consequences going to be if we go forward with this?
Well, there will be another crisis because one of the things I wish I didn't have to do, is I've been reading about bank failures in the United States and the creation of the FDIC. You can actually listen to FDR's speech, encouraging passage of the FDIC on their website. So if you want to hear it in his words, you can go listen to it. Every 15 years, America has had a banking crisis. It's not unusual, and it's because that's the role banks take. And what you need is the deposit insurance fund to make it orderly so there's not a panic. And what we learned in the recent crisis is money moves faster than ever before. If you read the testimony of Greg Becker in front of the Senate, what you'll see is essentially 85% of his deposits fled in 48 hours. There's probably no bank in the world who can survive that without some sense of liquidity. This is what the FDIC was built for. They should modernize the insurance fund, and they should protect mid-sized banks so small businesses can leave their money in the small bank. By the way, if a small business puts their money in one of these big banks, the deposit goes to the big bank and gets lent somewhere else. You leave a money in a regional bank, it probably gets lent in that neighborhood and in that region.
So the policy response did not match the failure, in your opinion. Why?
Yes. What I hear is there are an equal number of Republicans and Democrats that don't favor it because they believe that it will create a moral hazard for the banks, and it'll be a license to go create another chaotic moment. 3 banks failed spectacularly last year because they didn't get it right. 4,700 didn't. Okay, most of the industry got it right, and there actually are some common themes to the 3 that failed. So realistically, the industry can handle it if you supervise it right. So if it's done right, and I think the economy is going to need it, because if what happens is these mid-sized banks believe they need to be part of a bigger bank to offset the implicit guarantee, and this happens over a long period of time, then you're going to lose the small business lenders, and suddenly you'll have a bigger credit crunch possibly in the United States when times get tough.
So putting regulation aside, I'm looking out to your idea that we're going to see growth, profit growth in June, that we're going to see this sort of bottoming out, and then people are going to start seeing these banks earn money. From where? Because we saw auto lending basically fall off a cliff. We saw mortgages having a real tough time. We've already seen that market basically die. And meanwhile, we have the issue of all of these private capital providers that are coming into your space. I mean, how much can you really see that growth?
I think you just listed the agenda of a typical bank board meeting. Like those are like all the things that like when I go to a bank board that we talk about. Like, have you seen our board books? That was pretty good. So the reality is yes, yes, and yes, which is, you know, we're doing something we've never done, which is unwinding massive support post-pandemic, and it's kind of messed with everything. So nothing's happening like it normally does. The industry essentially ran out of deposits because of all this COVID money, and deposits had been shrinking. Loan to deposits is the key ratio in the industry. If the banks don't have liquid access, because the banks are competing with treasuries. I heard Bill Gross's interview with you earlier today. Take a 5% T-bill. That's a pretty good return rather than putting it in the bank. So that's not giving the banks the fuel to make loans. That will correct itself, and we think it will by the end of the year. Also, as the economy starts to look better, banks will get more eager about lending. It's all about a reset moment, and I think we think it happens, but it happens very slowly. But like you said earlier too, Lisa, which is all we need is non-chaos for these stocks to go up because there's been so much bad news in them.
My favorite stat of yours, just to stand out, that back in 2008, of the top 10 mortgage originators, 8 were banks, and now that number's 3. Isn't that amazing?
It's amazing.
The change we've seen.
And you know, so we're talking about like this Basel endgame. Don't think for a second that these rules don't have major implications. And here's the real problem, is that the regulatory proposals are to de-risk the banking system. The business is still going to get done. It's just going to get done in an unregulated place, which I can't believe we're better off with. We get a lot of talk about what we don't want, but we don't get a lot of talk about what we do want, which is we have the greatest financial system in the world. Why are we changing it so much without an end game policy? But to get to your point, in 2008, 8 of the top 10 mortgage originators in America were banks. Today it's 3. Banks only make 25% of the mortgages in America today, and that's happened because of regulation. And that's why, I'll even throw another curveball at you on this Basel endgame. For all of us who read about the global financial crisis, one night, all the biggest investment banks in America became banks. Now, we're going to get a capital charge on investment banking activity. They're trying to push investment banking activity out of banks after they were all required to become banks. We're going to do the full circle. And by the way, Investment banking's still going to get done in the United States. It just won't be in a regulated entity like a bank.
You just need to stare down the barrel of the camera and address the senator from Massachusetts directly in
think
future.
he is.
All right, Tom. Thomas Show, KVW, is going to stick with us. Tom, it's good to see you. Time now for a look at some of the other stories making headlines this morning. Let's catch up with Yahira Hackers with your Bloomberg brief. Morning, Yahira.
Good morning, John. New Hampshire heads to the polls in the nation's first primary. Donald Trump and Nikki Haley vying for the GOP nomination. The first batch of results coming from the small town of Dixville Notch, with all 6 votes going to Haley. Israel says 24 soldiers were killed on Monday after an attack on a tank and explosions at nearby buildings. This marks the worst single-day death toll since its war against Hamas began in October. Israeli forces are advancing deeper into the southern and central parts of Gaza while facing mounting pressures to wind down the fighting. Eurozone credit demand is bottoming out, according to the ECB's latest bank lending survey. Demand has been falling for more than a year on the back of rising interest rates and a struggling economy. The survey shows that the drop in appetites for business and consumer loans was smaller in the fourth quarter than in the previous 3 months of last year. That's your Bloomberg brief. John?
Yahira, thank you. Up next on the program, a pivotal day in the Republican presidential race.
Republicans have lost the last 7 out of 8 popular votes for president. That is nothing to be proud of. We should want to win the majority of Americans. But the only way we're going to do that is if we elect a new generational conservative leader.
That's next on the program. This is Bloomberg Surveillance.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. When will the ECB decide to cut rates?
We are on the right path, but I'm not going to shout victory.
Bloomberg Television brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
The wages issue is what I think the ECB is really focused on.
June is our base case.
There is still a 50-50 chance of a rate cut coming just slightly before that.
In many ways, they should have been cutting already early to stimulate growth.
The ECB decides, Thursday on Bloomberg Television.
Three days of gains on the S&P 500, the longest daily winning streak of the year so far. The year is young, but the three-day winning streak is it at the moment. Equity futures on the S&P 500 just about positive by 0.03%. Yields are higher by 2 basis points, 412.82 on a 10-year. Under surveillance this morning, a pivotal day in the Republican presidential race.
We should want to win the majority of Americans. But the only way we're going to do that is if we elect a new generational conservative leader. I voted for Donald Trump twice. I was proud to serve America in his administration. But rightly or wrongly, chaos follows him. You know I'm right. Chaos follows him.
Chaos follows him. Here's the latest this morning. Nikki Haley making her final pitch to voters ahead of today's New Hampshire primary. The Republican field down to just 2 candidates and the former president holding a clear lead over the last remaining challenger. MH, it's down to 2.
Yep, it sets up another Trump-Biden rematch. This is what we hear from Greg Valliere this morning of AGF Investments. He says the theme in recent days has been who has the better or worse cognitive skills, but that's a losing issue for both candidates. But a better economy with data to support that improvement is a big deal. This looks like a Goldilocks economy, and if Americans finally begin to believe that, Joe Biden has a decent chance of winning re-election. John, it's that topic we keep talking about. Is the timeline on Biden's side?
Is the calendar on his side? We started to see consumer confidence pick up. We saw that in New Midge on Friday. Jobless claims are south of 200K. There's a pitch here to make. The problem is it hasn't resonated at all over the last 12 months. You wonder if it ever will. Joining us now is Henrietta Trace, the Economic Policy Research Director at Vader Partners. Henrietta, let's get straight into it. Your line, even if Nikki Haley wins New Hampshire, we see no path to her becoming the nominee. Why is that?
You know, we're basically just looking ahead. Nevada and South Carolina, the former governor's home state, are going so hard for Trump that she doesn't have a path forward beyond this. What Republican voters have been telling pollsters all year long is that they want Trump. The way I put it in my notice, nobody wants Diet Coke. They don't want all Coke alternative. They want the real thing. And they can have the real thing if they just pull the lever for him. And that's what I expect they'll do in New Hampshire, where he's polling up by at least 20 points in the data that came out this morning. And then looking forward to Nevada and South Carolina. And then on to Super Tuesday, there is no inroad for another candidate. So I think believe the voters when they say that they want Donald Trump. That's what Republicans are telling them time and again. That's how they voted in Iowa overwhelmingly. And that's what I suspect is the run path here going forward.
So if you have this rematch of Biden and Trump, where does it leave the independent voters, which many of them went for Biden last round? Do they still go for him this round?
That's the key question. That's the whole ballgame. 56% of those voters went for Biden in 2020, and the fight should be on for exactly those folks. It's about 28% of the population, spread nationwide. It only matters in a handful of states, so we'll be watching those very carefully. It's the same ones that you would suspect: Wisconsin, Michigan, Nevada, Arizona, Georgia. Although I do think that this year there's less likelihood that Democrats win Georgia. You know, Stacey Abrams had an incredible turnout machine back in the Senate races and in the 2020 election. Really need to turn that on. I would encourage folks to watch Jim Clyburn, who is getting much more aggressive. And he, of course, is integral to Vice President Biden becoming the presidential nominee and for Kamala Harris to become the VP. Those are two really important people to watch as they head into South Carolina, North Carolina, and Georgia in the general election cycle.
Since you mentioned Biden in South Carolina, can we talk about Biden being missing today on the New Hampshire primary ballot? Is this potentially going to be an embarrassment for him?
I don't think so. And I mean no disrespect to the lovely people of New Hampshire, but they are not indicative of the state of national politics the way that they used to be. So just as dismissive as I am about a potential Haley, you know, coming in 5-10 points shy instead of a 20-point blowout, I feel the same way about Biden. He's not on the ballot. I don't think there's any confusion about the state. He won by 8 points, if I'm not mistaken, in 2020. You know, the Democratic Party is shifting gears into a more representative and diverse primary election. And this is the first year where they're doing that. So there's some anomaly here, but I don't think that it is an arbiter of things to come.
Henrietta, I can feel the exasperation in some of these notes when you get these sort of people saying, what are the possibilities of anyone else coming into the race? You say the only way either Biden or Trump is not the nominee is if some sort of black swan event occurs before the convention and party leadership decides it is time or necessary to go in another direction. Henrietta, given the fact that it's probably, most likely, almost certainly a Trump-Biden matchup, from a policy perspective, what are you focused most on, both from the candidates and from the voters, with respect to understanding what a post-election period looks like?
this is the core thing I can't wait for people to sort of migrate to. We have a $2.7 trillion tax bill that has to be written in 2025. The potential for minutia on the corporate tax side pertaining to tech and pharma companies, to international trade, international taxation, domestic cap gains and dividends taxes. Those are, the bread and butter of what I love to do. So I can't wait to get into that conversation. But to be really honest, the most striking part that investors are actually focused on at this point is the potential for a universal baseline tariff. For those of you who remember the 2016 efforts from Paul Ryan to impose a border adjustment tax, it's time to dust off those old books. The universal baseline tariff is what investors get most keyed into, and they do not take Trump lightly when he says he would impose a 10% tariff on all imports. It is the primary revenue raiser in his tax plan. And as I mentioned at the outset, you must have a tax bill in 2025. All of the individual tax rates expire. Both Biden and Trump would extend them. It's just a matter of scale and scope and probably duration. And then, of course, the offset. How do you want to pay for that? Do you want a universal baseline tariff to pay for it? If so, Trump is your guy. Most people are taking that incredibly seriously versus the last time around when they assumed that the tariffs were something that he talked about but never intended on doing. Mexico, the EU, Japan, China, there is no difference between allies and foes in these tariffs being proposed by the Trump campaign. So I think a lot of folks, as we key into policy as opposed to just vibes, will start to think about both tax and trade as the primary outcomes of this election.
Well said. Henrietta Trades there, Aveda Partners. What was that? Policy, not vibes.
Yeah.
Policy, not vibes.
Well, we're still in the vibe, I think.
Sure.
Which is the reason why we're talking about it.
Coming up on the programme, United shares rising in the pre-market following better than estimated earnings. That conversation up next.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Three days of gains on the S&P 500. Equities look like this morning, struggling to make it day four, just about unchanged on the S&P. On the Nasdaq, positive by 0.07%. The longest daily winning streak of the year so far. Two record highs, two consecutive all-time highs on the S&P 500. In the bond market, the 2-year, the 10-year, the 30-year shaping up as follows. A 2-year in and around 440, 441 on a 2-year. We've had pushback after pushback, Bramo, from Fed officials against the idea that we get an early cut. And yet Goldman are talking up the potential for one, and Bank of America too.
Yeah, you are seeing a bit of a repricing in Fed funds futures, where you can see about a 40% chance priced in of a March rate cut. But does it really matter if it's March or if it's June, if it's March or May or June? I mean, honestly, at a certain point, I've been reading all of these notes where it doesn't ultimately matter if they start cutting rates and if they're doing so at a time where there's otherwise strong growth. So that, I think, is the bigger question right now.
The Thomas Show of KBW alongside is sort of nodding as Bramo talks.
Direction. That is the key, and I think it's unanimous that everyone believes that the next move by the Fed is a cut, which means people can start planning for that. Because the relentless increases was disorderly. Now we get something that's more orderly, and then so businesses can plan for that.
And the cuts are good for the banks now?
They are, because it'll decrease the competition that U.S. Treasuries are giving them for the deposits in an inverted yield curve.
Isn't that a big change from what we used to talk about?
Yes, because banks are typically asset sensitive, which means they do better when rates rise. But banks don't do well when things are disorderly. And 5.25 points in 16 months is, I would define that as disorderly.
Things were certainly disorderly at times last year, that's for sure. The 2-year at the moment, 441, yields up by, let's call it 2 basis points. I want to finish on foreign exchange. In the FX market, the euro against the dollar looks like this, negative by 0.2%, 108.64. Under surveillance this morning, voters heading to the polls in New Hampshire facing a choice between Nikki Haley and Donald Trump, the two remaining GOP candidates intensifying their attacks on each other in the lead up to the nation's first primary. Haley saying the U.S., quote, can't survive another 4 years of Trump, while the former president already looking ahead to a November matchup with Joe Biden. It's amazing how this primary has started and ultimately might finish in the next 24 hours.
Potentially going to finish very shortly. I am astonished by how much money was just spent in New Hampshire alone, more than $75 million. It has 873,000 registered voters. That's a ton of money in a tiny state. Nikki Haley has spent a lot of money and time there, and it looks like the former president is going to win it.
I wish that you could just go to one of these small states, they just mail a check. I mean, at a certain point, isn't that wouldn't that be more effective than trying to advertise in all of these ways when so many people have already made up their minds? Just saying, not that I live in one.
You want to make it easier?
Well, I'm just saying, I don't know, I feel like these are such
You want to make it more transparent.
Exactly. It's such a sort of small referendums, and it basically is becoming clear. We know what the outcome is going to be. When can we move on to policy?
Right now, we can talk about policy. It's about policy and not vibes. Henrietta Trays of Vader Partners about 5 or 10 minutes ago. Tom, how do you think about things? The prospect of maybe having a completely different regulatory backdrop with a Trump presidency in 12 months' time?
Yeah, I think it's very important because the president gets to build out his team who executes from the executive office. And you've seen a lot of approaches, and I'll speak to the area of my bailiwick, like we're talking about these Basel III endgame rules. Remember, Basel is an effort of global regulators to have globally systemic banks have a common-ish type set of rules. The United States just elected to gold plate theirs and come in, according to JP Morgan and others, 30% higher than the rest of the world. That was a very aggressive step. And I would argue that it's not as much about de-risking the banks as it is trying to really transform what the industry looks like. That's a pretty assertive step to take, and that's the debate that's going on. And so those types of decisions get made by the president's team.
Big 12 months ahead. I want to turn to this story. The US and UK are launching more attacks on Yemen's Houthi rebels in the latest efforts to stop the group targeting ships in the Red Sea. It's the 8th round of Allied attacks since January 12. The ongoing tension causing a spike in shipping costs. AMH, China to Europe rates up almost 400% over the past 3 months.
That's right, and you're going to see ships continue to avoid the Red Sea, continues to avoid the Gulf of Aden until they actually have this under control. What we continuously see from this administration is they want to degrade Houthis' capabilities, but at the same time make sure there's no civilian casualties. What did Biden say himself this weekend? Is it going to stop the Houthis? No. Potentially gives them a little bit less ammunition based off where they are targeting and some of the ammunition they're trying to take out.
Let's talk about the economic fallout, never mind shipping rates. How close are we to seeing goods inflation start to pick up again?
I've gotten so much pushback over the past couple of days, I've got to be honest. People saying, yeah, you're basically overplaying this. It's not going to cause massive inflation. You're not already seeing it. It's only going to be a European problem, which is the reason why the U.S. isn't necessarily going to come out with more sort of protracted efforts to stop this. I don't know. I'm curious, and I keep pushing back and saying I think it could be an issue.
I've heard the opposite, where an analyst said to me, it is affecting someone's bottom line at this exact moment. Maybe we're not seeing it as big as, say, when all the ports had those huge, pile-ups, but at this point, it is hitting someone's bottom line. The amount of money and fuel now it takes to go around Africa is a big deal.
Not just the Suez Canal, but Panama as well at the same time.
I would just say, if you were to think our macro risks in general, high or low, they're high. And so you could just add this to another reason. I think it just leads to a little bit of caution amongst the business community and investors.
Tom, this story's for you. Citi cutting its bonuses in its investment banking division by as much as 20%, according to a report by Financial News. It's the latest move in a major organizational overhaul at the bank, with 20,000 jobs set to be eliminated over the medium term. Bonus season on Wall Street, how good or bad is it?
Look, typically Wall Street is a pay-for-performance business, and investment banking, I know no one's crying for investment bankers, but has essentially been in a recession for the last year. So compensation typically follows revenue. So on a percentage change basis, it shouldn't be surprising. One of the things I read in one of the stories, though, is that a lot of the producers will get paid more than management. I would actually applaud them for that. That's actually, I think, a good step if that's happening.
I just wonder who the performers are. Are they in the tech wing, or are they on the trading floor, or on the banking floor? I mean, at a certain point, where is the outperformance going to come from as we see kind of banks shifting their models in a significant way?
Well, what I will tell you is that there's tremendous pent-up demand for investment banking services. All this time that there have been no IPOs and mergers have been slow, there's a lot of pent-up demand. And also, 5 or 6 years ago, we started the boom of private equity. There are a tremendous number of companies in private equity portfolios that are seasoning that need to be dealt with. There is, and my experience, I've been on Wall Street for 38 years. My experience is when it turns, it's not just a little bit. It usually turns a lot. And so once the market's open, you'll start to see a lot more activity. And I think Citi is probably like a lot of other firms, which is that you have to think, is what we're seeing now the new normal? I personally don't believe so. I think we will see, when we get stability and orderliness, like we've talked about before, there's a lot of business to be done. And I think a lot of price levels will have reset, which will allow things like mergers and IPOs to happen.
You're constructive about the end of this year. I will just say this about Citi. Getting paid in Citi stock has been like getting a bonus cut every year for a long, long time. That has not been a good thing, Bramo.
Except for right after 2008. In 2009, it was actually a really good thing, briefly, for a hot second. But you're right. So it raises this question, how do you then even the playing field and attract talent another way?
And one thing I will say is, we talked earlier about how big seems in times of crisis to be a safer place to put your money. Big hasn't necessarily been the best investment, or they're not necessarily the highest performing companies. So there are great small banks, and there are banks that are really big that have challenges. So so size isn't a determinant of success. It might be a determinant of depositor confidence, but not of success.
That was the story last year, that's for sure. Let's turn to earnings from United Airlines. The shares flying high in the pre-market after the company reported better than estimated results. The company also posting a strong profit outlook for the year, despite uncertainty remaining over the status of its Boeing MAX 9 jets. Brooke Sutherland of Bloomberg Opinion joins us now for more. Brooke, how are they getting this done with so many planes still on the ground?
I mean, I think their forecast for the first quarter is not great. I mean, that is a seasonally weak period for airlines, and it's been one that's particularly difficult for them to navigate in this post-pandemic period where you do not have that business traveler coming back in the way that they have historically. So they're looking for sort of a sharp turnaround in the second part of the year, and I think a lot of that is international travel and the sort of continued trend of travelers gravitating toward more premium options. The legacy carriers like United have really benefited in this market, whereas the low-cost carriers have struggled.
If they cannot get their MAX 9 jets back online, if they can't remedy some of these issues that they've complained about or Scott Kirby reportedly has, does that materially affect their outlook? Does that really hit their stock yet again, given that they had such uncertainty baked into their forecast?
I think you're going to see higher maintenance expenses. I mean, that's the knock-on effect for some of these airlines. Delta, when it reported earnings earlier this month, was talking about $350 million of extra maintenance expenses this year, just relative to last year, which was by no means cheap as far as aircraft maintenance. And it's not just the MAX 9. Remember, you also have RTX, which is doing a very costly recall of its GTF jet engine that powers the Airbus A320 jets. So you're talking about significant chunks of the aviation fleet potentially being grounded over the course of 2024. What that means for the airlines is that they have to keep flying older planes for longer, or they have to use bigger airplanes for markets that don't necessarily need that many seats. That all has a cost to it.
Just on a related point, GE came out and it disappointed right ahead of their big break-off, and you're seeing GE shares tank. What's going on in the industrial complex in the U.S., or is that just too broad of a question? Is this really a Boeing problem? Is this a GE problem? Is there something that's hampering these companies so that they can't get it done?
I think with GE, so this stock has really taken off like a rocket ship ahead of its breakup. I think people are excited about the possibility of having a simplified GE at long last. This is also a company that under Larry Culp has had a tendency to be very conservative with its guidance. And so I think we need a little bit more details there, but I don't know if that's necessarily sort of a macro impact. On the other hand, you did have 3M out this morning calling for flat to up 2% organic growth. That is not heroic. That is not something that's really going to get investors excited, particularly coming off of a 2023 that was very weak for short cycle industrial companies like 3M, those companies that have sort of the quicker turnaround times. They've really been struggling with this period of inventory destocking that we've seen. You had manufacturers build up a huge amount of inventory during the supply chain disruptions, and now they're working that down, and you're seeing orders start to slow. And we really haven't seen kind of the boom to the bottom line from any of these phenomenons that we keep talking about, whether it's reshoring, electrification, automation. It's just not necessarily showing up in a major way just yet in bottom lines. Now, analysts are optimistic that might happen in the second half of 2024, but we'll see if we end up getting that.
Brooke, just want to finish where we started, which is on Boeing and United. On Boeing specifically, how do you expect this to end? From the people you speak to, what's the base case right now?
I think you have to look at management, and I think you have to wonder how much longer you can keep the current management in place, just given the series of crises that Boeing has dealt with, big and small. Of course, you know, from the grounding of the MAX to then just having sort of quality control issues come up before this latest one involving the door plugs. There was improperly drilled fastener holes. There was incorrectly installed rear fittings on the MAX. And I think you have to wonder if maybe it's time for a deeper rooted cultural change. We were talking about GE. That is a company that has really gone top to bottom and sort of reworking the way that that business is run. And I think you need a similar change at Boeing, and that might have to come from somebody with more outside perspective.
Hey, Brooke, thank you. Brooke Sutherland there of Bloomberg Opinion. Bramo, the second time that's come up with Brooke, the cultural issues inside the company.
I mean, you can't avoid it right now because it's been a series of things, right? In 2019, there was this issue, and now it's just one hit after another. I mean, it's just the fact that they have to examine these plugs in different models. The fact that we saw a burning plane flying over Miami. This isn't helping.
It's kind of shocking, right?
Yeah, it is. I mean, this is not what you want to see.
Do you think there's a risk here? Perception, not reality, but perception, that the regulator starts to be perceived as being a soft touch on a company like Boeing because it's a national champion?
There is that issue. There's also an issue of, you know, who are they getting to inspect some of these and what kind of turnover are they seeing, especially post-pandemic. We hear this again and again, staffing issues post-COVID that have become really problematic and have created some liabilities in a number of industrial companies. So at what point will that really kind of shake out and normalize?
Huge, huge issue. Time now for some stories elsewhere making headlines this morning. Let's get you an update with Yahira Hackers from Bloomberg Brief. Hey, Yahira.
Beijing is considering a stock rescue package to stabilize its slumping market. Bloomberg learning that authorities are seeking to mobilize about $278 billion from offshore accounts of Chinese state-owned enterprises. That would be used to buy shares onshore through the Hong Kong exchange link. The plan, however, is met with skepticism, with investors expecting any stock rebound to prove fleeting without a fundamental fix. Netflix has bought the exclusive rights to the World Wrestling Entertainment show Raw. It's the streaming giant's first big move into live events. Raw will air on Netflix beginning in January 2025. Harvard University is beefing up its legal team for 2 probes brought by the House Education and the Workforce Committee, according to people familiar with the matter. The investigations focus on anti-Semitism on campus, as well as Harvard's handling of plagiarism allegations against former President Claudine Gay. That's your Bloomberg Brief. John?
Yeah, Hira, thank you. Up next on the program, the credit market gets the boost.
These are, banks that wouldn't have been able to issue last spring, and you wouldn't have been able to sell the paper even if you tried. And now they're issuing with little concession.
That's next. You're watching Bloomberg Surveillance.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Stocks on the S&P 500 look like this, totally unchanged after closing yesterday at another all-time high. Under surveillance this morning, a strong start to the year for the credit market.
We've had a tremendous few weeks in investment-grade credit. For example, I think just to speak to the amount of the way that sentiment has shifted over the last 12 months, you think about the regional banks and the issuance that they've done over the past week. These are, banks that wouldn't have been able to issue last spring, and you wouldn't have been able to sell the paper even if you tried. And now they're issuing with little concession and, multiple times oversubscribed on the books. So it's been a really large sentiment shift, and I don't expect that to change anytime soon.
Elisa, what a start to the year for credit.
And if you hear the pile on, it's coming from every corner of Wall Street. Not only the issuers seeing a good time to issue, the fastest pace of issuance in, I think, decades, but the buyers as well. Andrew Sheets, global head of corporate credit research over at Morgan Stanley, writing in a note, quote, "We don't see credit as sensitive to whether the Fed starts easing in March or June if the longer-term path is clear." In other words, rate cuts. Overall balance sheet health looks solid with plenty of dispersion. So here's the question, John. Is there anything that could crack that solidness in a soft landing situation, even if the Fed doesn't cut as much as people expect? Credit a lot of people see as potentially outperforming.
Let's ask Megan Robson, the head of US credit strategy over at BNP Paribas. Morning, Megan.
Good morning.
What a start to the year. January. Can we just start with the supply? What's the demand been like?
Incredible demand for the issuance we've seen. So, as you said, high-grade issuance, one of the top levels we've seen on record. And it's amazing to see IG spreads have actually tightened as we've seen all of that issuance. So we think some of it is corporates pulling forward issuance from later this year to now, given the strong demand. In the case of financials, we've also seen regionals take advantage of this environment, diversifying away from kind of their deposit base and locking in some long-term funding.
That's what I wanted to get to. Are they pulling forward this year's supply, or are they catching up with last year because they couldn't issue?
It's a great question. So if you look at long-term debt growth for investment grade, it's still very muted. We're still at 1% growth. So this isn't a huge boost in issuance overall in terms of the long-term trend. So I think there are some issuers that are catching up, but there's also high-grade issuers that we've talked to that we're contemplating issuing in third or fourth quarter and are just taking advantage of this demand. Investors are thinking this could be the last time they have this opportunity to lock in yields and investments at these levels, and so that's why we've seen so many deals oversubscribed.
Some skeptical people could say, if they're issuing now to get ahead of something that is less favorable, that means that yields are going to rise or that spreads are going to rise. And yet nobody seems to be calling for that, certainly not on the investment side. So can you kind of bridge that gap?
Well, I think we're pricing in this high for shorter environment, as you said, which should benefit the refinancing risk, I think. But the open question, which is still very debatable, is if these lower quality issuers are going to be able to refinance later this year. So we've seen a lot of high-grade issuance, higher quality issuers refinance, but for triple Cs, you still have 25, 30 issuers that need to refi this year. For them, the refinancing penalty is still 400, 500 basis points. So that is a major risk for the credit market still.
We have Thomas Schode here, the head of KBW, nodding vigorously to what you're saying. What could go wrong? I mean, basically, given that everyone seems to be seeing this sweet spot in credit.
Well, it's interesting because right now the consensus is pretty strong, so you have a lot of believers in the soft landing. The risks that we identify is around credit quality. We are forecasting a 25% increase in credit costs for the banking industry for this year, but that is still below what's normal. So you could argue that the banks are still over-earning on credit. When credit costs go up, it shouldn't be a surprise. The surprise is for how long it's been so low. But yet when we do our channel checks and when we look at the recent quarter earnings, yeah, non-performers are up a little bit, but they're one-offs. Credit quality is still excellent, I would say, in the banking industry, and there's nothing on the horizon that's making us nervous about it. But you've got some big issues. Now, commercial real estate is a big issue, but we think it's primarily specific to the big cities and the big properties, and we also believe that non-banks have at least half of that exposure. It's not all banks that have that exposure.
Megan, would you agree with that?
So I think we were surprised in the financials earnings to see how positive the credit picture was for financials. So CRE losses increased a bit, but overall very muted. And so I think CRE remains an overhang, but very slow-moving train. And so the positive credit reporting on financials was definitely, I think, supportive and has helped demand for many of these deals.
And I would say from a bigger picture, pardon me, is it just means the worst case scenario is further off the table. And it makes people feel more comfortable that we're in a more orderly, typical market because we're seeing no directional changes that said, hey, some of those risks everybody was worried about last year are happening. We're actually getting further from that rather than closer.
Megan, if people had said maybe 5 years ago, 6 years ago, that rates would be at this level and that a lot of these high-yield companies that had borrowed at zero were going to come and have to survive, people would have said this is going to be Armageddon, you'd have incredible mass defaults. Does it ever surprise you that we're here and people are talking about this sanguine environment where everything's going to be fine and companies are going to be able to survive at these levels?
I think it's very surprising to us. It has been. I think the liquidity backdrop has been very, very supportive. That's one factor. And then I think look at the data. It continues to surprise to the upside, consumer sentiment, retail sales last week. I think if we start to see earnings growth and EBITDA start to really be more challenged this year, then I think that could really bring that risk back into the discussion.
And what I would say is I think that the forward market's going to favor companies with earnings, and you saw it in the stock market, and you're going to see it, I think, in the credit market would be my perspective and our perspective. And also, as we get orderly, those companies that might have that trouble that you were alluding to, if we get an M&A market, they'll sell before they'll have to refi their debt. Now, when there's a crisis, you can't even do that. But if we get stability, they will take actions to correct before they have to go to market with a tough deal.
Megan, just final question. Favorite trade for 2024? What is it now?
Favorite trade, so we like decompression still, over outperformance of investment grade over high yield, top conviction there.
Megan Robson of BNP Paribas, constructive on credit. It's amazing to see how busy things have been to start 2024. Tons of supply, tons of demand, straight out the gate.
And at a time when rates haven't gone down that much and they could potentially stay here for quite a while, at a certain point, if the economy does well, people are happy, although it's so funny. It tells you where we've been. That, we heard Tom say, as long as they have earnings. The fact that we had companies with no earnings that borrowed for as long as they did tells you something.
Tom, things are getting better.
Well, I got to tell you what you just said. Say, gee whiz, I'm glad we're positive on the investment banking stocks, which is what, yes, we think
can finish
that
there. You are super constructive, I would say, looking for that re-acceleration year-end with the one thing that could disrupt it, credit issues.
Correct, and we were just talking about it. And those are things like commercial real estate and also consumer credit. 3.7% unemployment rate is probably better than we would have expected. We are seeing stress starting to come into the consumer, but it's still, the companies that are major consumer lenders talk about it as we're normalizing. There isn't a sense that we're breaking out to another level, but that's something to watch.
Hey, Tom, I've loved this. It's great to see you. Tom
Good to see you as well.
KBW, Megan Robson as well from BNP Paribas. Bramo, how long have we been talking about CRE? Commercial real estate. For how long now? Just waiting for that to work through the economy and waiting.
It's been 3 years. Remember when the pandemic hit, lockdown, Armageddon, and I've been saying that word a lot today. I apologize. I'm going to move back. There was a real question around the survival of office space just in general, and now you have a reset. In certain pockets, still distressed, but it's been basically, people think, maybe priced in.
If you missed the coverage of Bramo in Davos, Switzerland at the World Economic Forum, constructive.
Okay,
I would say on the edge of hopeful.
No, responding.
She was optimistic.
A couple of days back in New York City, and it's Armageddon on repeat. In the next hour, we'll head to New Hampshire for the latest, plus Priya Misra of JP Morgan Investment Management, Michael Gapin of Bank of America, Kaylee Kaminsky of Alpha Simplex, all of that still to come. Live from New York, this is Bloomberg.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port destinations.
Functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How about the Instagram? Can you think about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
You later got asked to be the head of USAID.
I got that job when I was 36 years old.
36 years old. You're running USAID. How many employees does it have?
We had 11,000.
And did you feel qualified to run something that big?
I did until, the work started.
Our sense is the markets are well ahead of themselves in terms of rate cuts. The Fed's telling you they're going to cut, not hike next, and they're pricing probabilistic outcome into this.
I actually don't see a huge gap between the market and what the Fed ultimately wants to do.
They're going to be taking a read on that macro outlook to figure out when to cut rates. The market's sort of, in my view, a little bit over its skis.
Every now and then, things get ahead of themselves, and to us, this is one of these times.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz, together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market on the S&P just about positive after 3 days of gains on the S&P 500, the longest daily winning streak of 2024 so far. It's been record high after record high. The financials in the rear view mirror. We're going to be talking about the tech a little bit later on this afternoon.
Netflix, the first of the bunch, kicking off things. We're going to be hearing also from Tesla later in the week, as well as Intel. Here's a key question. How high is the bar? We were hearing yesterday, maybe it's not that high for the tech names, but we've seen disappointments and they've been punished even this morning. So at what point do we get that blowback to this soft landing nirvana versus the opposite, which seems to be pile-on this morning?
The United States wins, right? The US wins. Let's just focus on tech numbers for now. This is where these big tech firms are. Europe is where they're not. China at the moment is really struggling. The difference between the United States and China this morning, I think we sit on that for a little bit longer. We've got the US at all-time highs and China trying to come up with a new plunge protection team to stimulate demand in its equity market. That is night and day in global equities.
2 questions or 2 points. This is sort of a China-specific question and how much the U.S. and Chinese markets have diverged, and economies for that part, given what we've seen. And then you can ask this question about how much the U.S. is alone more broadly. Right? We've seen this with Europe. We've seen this with other countries and other regions. The U.S. has continued to shine, and it has been those big tech names, even at the expense sometimes of everything else.
The market's good. The politics is a little bit messy. We can talk about New Hampshire. We're down to 2. It's Nikki Haley versus Donald Trump. AMH, we're told repeatedly by many people on this program already in the last 24 hours, this race could be over by tomorrow morning.
It does feel like a make-or-break moment for Nikki Haley. We saw the way Trump swept through Iowa. There's potential for Nikki Haley to break through in New Hampshire. It is a place that she spent a ton of time. It's feudal ground for her. But the problem is, the polls show the former president's winning. And then what's her path after that when she's already down her polls in her home state?
I feel like a lot of the reports and a lot of the analytics right now has moved beyond Nikki Haley. And for better or for worse, a lot of people are just saying, when will she drop out? Not what is her path to be the candidate. So here is the question. When do people start moving to the policies we've been talking about this morning, the potential for some sort of blanket 10% tariff, which Donald Trump has talked about? Do we start talking about that? When do we start talking about what the U.S. looks like under whoever could win this rematch?
I think right now, Bramo, I think the problem that I have and the worry that others share is that we have a foreign policy vacuum at the moment. We've got the United States and the UK struggling to restore order in the Red Sea. And do you know what the perception of things right now is of America? That there is weakness, and it could well be replaced by strength in the next 12 months. Just how vulnerable are things on the international scene at the moment?
Well, I think it says a lot, the fact that you said it's only the U.S. and United Kingdom that are there in the Red Sea striking back at the Houthis. No other countries are joining the United States and the UK when it comes to pushing back on the Houthis and what they are doing to global trade that's in the Red Sea.
BlackRock put out a note yesterday where they said that things have changed on the geopolitical front, and that when they take a look at geopolitics as a risk point, it has gotten much more front and center than it has in the past, exactly to this point, John, which is that these uncertainties could flare up in ways that people have underpriced, and BlackRock sees this as kind of feeding into an inflationary impulse that has a longer sort of tenure.
Marko Kolanovic, JP Morgan. Quote in his research, we believe the disinflation process is likely to slow or stall in the first half of 24, in part due to the impact of shipping, supply chain disruptions, and upside risk for energy prices. Now, you said you've been getting pushback. Marko Kolanovic is speaking for the same hymn sheet with you.
It makes sense. I mean, if you just think about it logically, if you have to go all the way around South Africa to have the same kind of voyage, isn't that going to be problematic and add to wait times?
Let's get you up to speed on the price action. Equities are positive by 0.1% on the S&P 500. Equities higher, yields inching higher as well by about 2 basis points. Least on a 10-year, 412.62.
Just creeping higher, but we haven't seen really kind of any fallout in the stock market. I just got to say, still, even though the data has been better than expected, it hasn't really spoken to this re-inflationary kind of vibe, because you still see inflation expectations coming down. That said, at a certain point, higher yields are going to be a problem for risk assets.
Let's get to the top story this morning. Markets at all-time highs as tech earnings begin. Investors looking ahead to results and placing their bets on rate cuts. Katie Kaminsky of Alpha Simplex writing this: fixed income cut optimism is fading and yields crept back up recently. The general view is that inflation could be stickier than hoped, and it will take more time to get to rate cuts. Katie Kaminsky joins us now for more. Katie, let's talk about that spread, and welcome to the program. The difference between the perceived view of the Federal Reserve and what the market is priced for right now. How do you expect that spread to reconcile?
Well, if you look what happened, I mean, it was a massive reduction in yields. And I think people are just ready to throw in the towel that, it's time for cuts, let's move on. And what we've seen this month is people capitulating a little bit and saying, it's actually not that easy to get inflation down that quickly. It's going to take more time. That doesn't mean we're not in the right path. It just means that this disinflation hope is not really sort of going to happen in a month. It's going to take 3, 6, a few months for them to actually capitulate, for the Fed to also capitulate and say, it's time to make cuts. That's how I see it.
So then why is long the new short, Katie?
Well, long's the new short because we finally saw a pivot in the fixed income market after 9 quarters. We were looking for we were looking for the end of the rate hiking cycle. And when you think about it, I mean, bonds still look good. They still have positive carry. And what we're trying to find now from a technical perspective is a steepener. And I think that's probably what is the shape of the yield curve is really the question for us right now this year. But it doesn't mean that bonds don't look somewhat attractive.
When you say bonds, is there a particular tenor that makes sense to you, especially as we embark with the 2-year auction today on $162 billion of Treasury auctions this week alone?
Well, let's just say that short-term fixed income is still a really nice return. And then when you look across the yield curve, I'm a little more reticent about long-term bonds because we don't know yet how things are going to play out. I know credit could be an issue. We could see a resurgence in inflation. So my general view is to be a little bit cautionary when you only have a very small premium for long-duration bonds. So a steepener is probably the best position for that. So long the short end, short the long end.
Kelly, can we pick up on that final point, the prospect of inflation re-accelerating? Marko Kolanovic of JP Morgan saying, we believe the disinflation process is likely to slow or stall in the first half of this year, going on to say in part due to the impact of shipping, supply chain disruptions, and upside risk for energy prices. Do you share that concern?
Yes, I do. And the reason for this is if you look at the signals recently in the commodity markets, we have been watching for a little bit of an uptick in energy prices, and you've seen that this month. It's just showing us that there are still some large risks that could easily cause some vulnerabilities in those sectors, which may lead to potential pass-through effects to companies. So it's just going to take time to get inflation down to what we're used to if we continue to have some issues.
Katie, can you just build on that a little bit more? How much time would it take for those pressures to start showing up? Would you expect that in the next few weeks, the next few months? Where on the calendar would you expect the tension of the last few months to land going forward?
Well, the thing that's challenging with this is we have to see commodities actually move pretty quickly. I'll just be honest with you. So that's why we're watching them. If you look at what happened during the Ukraine crisis, commodities moved first. So I would expect if we actually have problems, we will see that in the short run rather than the long run. So that would be sort of a catalyst to a longer term move that could potentially affect inflation.
Katie, last year you came out and you had the most conviction to short bonds, which was counterintuitive. And for the bulk of the year actually did really well. What's your highest conviction now heading into a 2024 that feels rather convictionless other than the soft landing?
So I think the biggest trade that we have seen that surprised us so far is this divergence between US and China and even Japan. I think the best trade this month has been long Japanese equities and short the yen. So that is something that people have been questioning us about for months. And it's surprising that that continues to be a very interesting differentiator across the board.
Hey, Katie, appreciate the update. Thanks for being with us. Katie Kaminsky there of Alpha Simplex. You'd expect it to show up in energy markets first. Check out crude. AMH still in the 70s, even with what we've been talking about now for months, since early October.
It's also unbelievable that we're waking up to another night of airstrikes in the Red Sea, and energy prices are down this morning in the red when you look at WTI and Brent.
I mean, this is how much this is just U.S. policy, right? It's basically how much we're pumping. At the same time, you do wonder where the margin of increased production comes from should there be a more material disruption, because this is all just a slow grind, not necessarily some sort of massive, obvious disruption. Also, Libyan oil came back online. People are pointing to that too.
79.32 on Brent crude. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Aberdeen is preparing to cut hundreds of jobs, according to Sky News. The firm will reportedly announce layoffs and a trading update tomorrow. Aberdeen has declined to comment on the reporting. The UK-based investor has already slashed employee benefits as part of a cost-cutting plan last month. Bitcoin has fallen over 20% since its intraday peak on January 11th, when the first spot ETFs debuted on the market. The largest digital asset spiked above 49,000 and is now hovering below 39,000. A net $1.2 billion flowed into the group of 9 funds during the first 6 days of the launch, according to Bloomberg Intelligence. And Liverpool FC is said to be in talks with various media groups about a behind-the-scenes documentary. Bloomberg learning that the club's current manager is supportive of the project after turning down interest from Amazon's All or Nothing series in 2018. Liverpool was part of a subject of a 2012 documentary, Being Liverpool. That's your Bloomberg Brief. John?
Yahara, thank you. Bramo, who isn't doing this?
Exactly.
Who isn't doing this right now?
This is the playbook. Turn your sports team into some kind of, drama series or dramedy or something like that.
Tennis did this.
Yeah.
Football's been doing it for years.
Yeah.
Formula One has been doing it. Who isn't doing it?
I mean, maybe horse racing. I haven't seen a lot of those.
You're going to start doing that as well.
I mean, I guess so. I don't know. Maybe, aquatic ballet.
Aquatic ballet.
I'd watch this. Mohamed Salah behind the scenes.
Yeah, I mean, I think a lot of people would. But this has been the playbook, Bramo.
Exactly, because you basically get the money from that, you drum up support. It doesn't really matter if you win or lose. If you create the emotional dramas, the personal stories, then if you win, it's that much more personal. We've seen this again and again, but is this the new playbook outside of, say, that contract that's dependent on advertising revenues, et cetera?
Bob Michael of JP Morgan Asset Management keen to see that Liverpool documentary. Up next on this program, Haley's last-ditch effort to take down Trump.
You've seen the Republican Party coalesce around Donald Trump. There's bigger buzz around who could be his vice presidential pick rather than can Nikki beat him here in New Hampshire.
That's next on the program. You're watching Bloomberg Surveillance.
Britain's next.
Was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The 2024 nominating contests are here, and the candidates are making their cases to New Hampshire voters ahead of the primary.
New Hampshire is going to speak very loudly.
Bloomberg is live in the ground, bringing you the fastest news,
Trump is leading by a long shot.
insightful interviews,
Nikki is the one that has knocked all these other candidates out of the race.
and the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
Coverage continues today, only on Bloomberg.
One hour and 15 minutes away from the opening bell. Equity futures on the S&P 500 just about unchanged to positive by almost 0.1%. Yields bleeding a little bit higher by 2 basis points. Your 10-year 4.12.62. Under surveillance this morning, Haley's last-ditch effort to take down Trump.
What have we seen for the past 6 months? Head-to-head polling that shows Donald Trump potentially beating Joe Biden in many of the swing states. That has been a psychological factor that has been truly underreported, and now there's a feeling of inevitability. You've seen the race, you've seen the Republican Party coalesce around Donald Trump, and possibly even there's bigger buzz around who could be his vice presidential pick, rather than can Nikki beat him here in New Hampshire.
Donald Trump and Nikki Haley squaring off in the New Hampshire primary, a make-or-break moment for the former UN ambassador. Julian Emanuel of Evercore saying Governor Ron DeSantis' endorsement increases the odds Trump wins and helps him, quote, become a virtual lock to become the GOP's nominee. MH, we've said it all morning. It could be over by tomorrow morning.
Absolutely. But Terry Haynes talking about Governor DeSantis, where does his voters go? He writes today, the key is how much Haley gets of the around 15% Ghost, Christie, and DeSantis New Hampshire vote. Haley needs almost all of that 15% to pull roughly even with Trump. Our instinct is she falls short of it, making Trump a clear favorite and putting Haley's campaign on life support. But a turnout is at or above 300,000 at the New Hampshire Secretary of State predicts. Haley could surprise. We have to wait and see. It's not over just yet. But if polls are right, it is. But let's see what the turnout is.
Let's head to New Hampshire and catch up with Bloomberg's Katie Lyons. Katie, can Nikki Haley get it done?
It's been described to me as an uphill climb today, John. That frankly is what we're hearing from almost everyone, that this is going to be very hard for her to pull off. Anne-Marie is absolutely right that this is going to be primarily about turnout today. The Secretary of State, David Scanlon, actually joined Bloomberg yesterday, predicting more than 320,000 voters could turn out to vote in the Republican primary. Americans for Prosperity Action, the super PAC that is supporting Haley, has said something closer to 340,000. But it's going to have to be a number like that, a real turnout, a show of these independent and undeclared voters that could break for Haley, that would actually help her potentially cross the finish line. But polls suggest that this is going to be incredibly difficult to pull off. Suffolk University and Boston Globe have a tracking poll. The latest poll this morning on the day of the primary shows Trump at 60%, 22 points ahead of Haley. That is the widest spread we have seen this week. And typically, yes, New Hampshire is able to deliver upsets. It's happened historically in the past, but you see candidates who ultimately end up upsetting, gaining in the polls leading up to the day of the vote. And that is not what is happening for Nikki Haley in 2024.
Could we talk about the name that's not on the ballot, Kaylee? President Biden is not on the Democratic ballot today. And you caught up with Representative Phillips, who says if he doesn't get a very large showing, if people write in his name, then he's perceived as weak. What did you take away from that interview?
Yeah. Well, it was really interesting to hear from Congressman Phillips, who, of course, is competing for the Democratic nomination and has been campaigning here in New Hampshire, while President Biden is not, because President Biden has, with the DNC together, decided that South Carolina should be the first primary because of its more diverse base of voters. So that's why there is just a write-in campaign that the president and his campaign can't directly support. It's through different surrogates like Congresswoman Annie Kuster. It's going to be a question of what kind of number Biden actually can put up through that campaign, considering incumbent presidents here in New Hampshire in the past have secured 80% plus of the vote. And that is really the marker that Dean Phillips laid in the sand for us when he joined us here at Bloomberg yesterday. He thinks Biden should be putting up something 80% plus. If he doesn't, then that's a question of whether or not he is a weak candidate, because that is the message Dean Phillips shared with us, that this is a weak, unelectable incumbent president. He thinks that is dangerous if the goal is to unseat Trump or to make sure that Trump can't once again take the seat in the Oval Office in 2024. And Dean Phillips told us he thinks we'll all be surprised by his showing here in New Hampshire today. He's saying he could maybe get above 20%.
Well, he's up against some 20 names on that ballot. If we come back to the Republicans, in Iowa, within 30 minutes, we knew who won the caucuses. How quickly are we going to see the New Hampshire votes materialize?
Well, polls will be closed across the state by 8 p.m. tonight, and there has been talk of could we see an 8:01 call, because, yes, the Associated Press and major networks called Iowa about 30 minutes after the caucuses even began. They hadn't even finished yet at that point. It really is going to come down to how close this race is. The issue in Iowa was that Trump was leading by such an overwhelming margin that it was very clear very early on that neither Nikki Haley or Ron DeSantis or Vivek Ramaswamy, two individuals who, of course, were still in the race at that point, were going to be able to catch him. If it is a tighter race than the polls suggest this evening, then it may be more difficult to call as early as we saw in the First in the Nation caucus.
Kaylee, let's talk about weather, because everyone was talking about weather in Iowa, and that was the reason why turnout was so bad. I'm looking at the weather in New Hampshire. Today, it's going to be a high of 38 degrees and a low of 28 degrees Fahrenheit. It seems just fine for New Hampshire. Is that really going to determine turnout? Are you expecting to see some sort of turnout that is much bigger than Iowa?
Well, Lisa, I have to say, it feels like the Bahamas here after Iowa last week. This is more than 45 degrees warmer than it was in Iowa. So, yes, weather could play a big factor in driving people out, which may be contributing to some of the high numbers we are seeing from the likes of the Secretary of State, north of 300,000. But really, turnout is driven by enthusiasm in large part, right? And that is another thing we have to consider when we're looking at the polls between Nikki Haley and Donald Trump, is that Trump voters are just much more enthusiastic about his candidacy. They are far more likely to say their vote is for him rather than against Haley. With Nikki Haley, a large chunk of her voters are voting against Trump, not necessarily for her, and that enthusiasm gap has been significant. That was the case in Iowa as well. So that could be a real factor here. Does the base of Trump feel more impelled to go out and actually go to the polls and vote today versus those who might not be as excited to go cast a vote for Nikki Haley? That said, on the other side of the coin, you could say that Trump is leading by such an overwhelming margin right now that some individuals may think he's going to take this anyway. My vote won't matter as much. So it really is the enthusiasm factor in addition to the weather that we have to consider when we ultimately see what the numbers look like today.
Kelly, looking forward to the coverage later on. Kelly Lyons there in New Hampshire. Look out, tune in to Bloomberg tonight, 8 p.m. Eastern time, complete coverage of the New Hampshire primary. AMH, let's talk about it. That enthusiasm gap is absolutely massive between the former president and Nikki Haley.
It's impossible to really run a primary with someone in your party who people feel like is an incumbent. And at the same time, Governor DeSantis, when he was leaving the race, he said, I was picking up steam. And then you couldn't get through the oxygen in media, given the fact that everything was pointed towards Trump and his legal troubles, and Trump made his legal troubles really an election campaign issue.
He ignites a lot of emotion on both sides, which is the reason why they say that Nikki Haley's one path would be to sort of ignite the opposite of the love, but the alternative to love that some people feel toward Donald Trump. So this is sort of the question: is it a referendum on him? A lot of people saying you're seeing the coalescing of the Republican Party. I've got to say, I'm not that jazzed. I feel like people have moved on. I feel like it's sort of gotten this sort of inevitability about it at this point.
You know what's amazing about this, though? If Nikki Haley did become the candidate, the win that we would see on the national stage, how big it would be absolutely humongous. And that just tells you how deeply unpopular the current sitting president actually is. No one wants this outcome. I say no one to use that loosely, but ultimately you look at the polls, AMH, they speak for themselves.
Yeah, the polls show that Americans do not want a rematch of this race, but that's exactly what they're going to get. the next few months is all going to be about what does the Trump campaign look like in swing state votes versus what is Biden doing in these swing states. And you're going to see a lot of visits, like you are this week, to Wisconsin, to Michigan, to these states that are must win, because that's where elections are won and lost. Forget the nationals.
Yeah, but what does it say that a candidate that would be so easy to win on the national stage looks so impossible to win on the primary stage? And that tells you a lot of the polarization that we've seen in the different parties.
It's a question of why America chooses candidates this way. Why was $75 million spent in New Hampshire where there's 830,000 registered votes? Or why does the first caucus start in Iowa?
I think I should move to New Hampshire and just get a check.
To New Hampshire?
Honestly, it's good, great skiing.
It's good skiing. I didn't know that. Have you skied there?
Yeah, it's great skiing.
And you can vote in primaries and maybe have an
You
impact.
could go and do the coverage tonight with the team, Kelly Lyons, Joe Matthew.
I could head up, be wearing my, balaclava.
On the
and
slopes afterwards.
Yeah, exactly. No, that's not going to happen.
Coming up on the program, Michael Gapin of Bank of America, looking ahead to some critical inflation data due out later this week, and looking forward to a Federal Reserve meeting just around the corner. Before we get there, it's the ECB. Michael Gapin thinks you get a rate cut as soon as March, and you get a soft landing too. That conversation is just around the corner. Equity futures on the S&P 500 positive here by 0.1%. Yields are higher by 2 basis points, 412.62. Consensus is maybe the middle of this year, but Michael Gapin's got company. Jan Hatzius of Goldman talking to our team in Hong Kong, Bramo, about a little more of the same, March cuts.
March cuts, soft landing. What else do you get? An ice cream? I mean, seriously, these are incredible projections.
Rainbows, unicorns,
exactly.
And lollipops and all that good stuff.
That's where we're headed.
Soft landings and tons of rate cuts and all-time highs in the equity market.
Great.
Coverage up next.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Stocks on the S&P 500 positive here by 0.1%. On the Nasdaq 100 going into the opening bell. About an hour from now, we're positive by 0.33%. The Russell bouncing back up by 0.8. Talked about it all morning. It's not about the financials anymore. Bramo, it's about big tech a little bit later.
Netflix kicking off the big tech earnings later today at 4 p.m. Eastern, and then we get Tesla and Intel, and then next week we get really some of the big behemoths. The question is, how low is the bar, or how high is the bar at a time when this has really been the driving force behind the entire rally?
It's my favorite time of the year. You get the tech earnings and a Federal Reserve decision around the same time.
Is that sarcasm?
No, I'm serious. I'm serious. You get tech earnings I prefer. I told the bankers in Davos this last week. I wish they would deliver the earnings after the bell and not before the bell, all at once in the morning.
I know. I knew we were going on this.
You never get to read them. Then you've got a bunch of earnings calls, then the market opens up, everyone's busy. In the afternoon, after the close, tech comes out, you can actually sit there and read the earnings and listen to the calls.
And that's actually going to be hugely instructive, because the reason why the U.S. has diverged from everywhere else, China in particular, has been because of the big tech names. And they've been the ones that have been leading. The key question to me, though, is, are you going to see a broadening out in some of the earnings? Because we're also getting, I think, 5% of the S&P today reporting earnings. We got a bunch of the industrials. So around the margins, the next 2 weeks are going to be massive, just more broadly for earnings.
Luke Carr of UBS looking for that improvement of breadth in the equity market, just broader participation maybe. I want to turn to the bond market, 2-year, 10-year, 30-year. We'll be joined by a gentleman who's looking for a rate cut in March in just a moment. A 2-year at the moment, around 440, 439.97. Yields higher by 2 basis points on a 10-year, 412.24. Just to finish on foreign exchange, I keep reminding myself of this. I'm not trying to remind you at home. There is an ECB meeting this week. We're at 108.67 on the euro, negative by 0.1%. I'd forgotten, to be honest with you. This one's come around quickly.
We already had it last week. You pointed out. We had it a couple times with Christine Lagarde. They're not going to say anything, right? I mean, what are they possibly going to say that's going to move markets, given the fact that people are basically expecting them to cut rates in the summer, which is essentially what she said last week at her press conference with Christine Lagarde.
News conference round 3. Yes. It's going to be far more interesting. How many journalists are going to ask about the politics of the United States, whether it's appropriate to weigh in to US politics, her response to the reports around the dissatisfaction of the staff inside the European Central Bank. There's a lot to discuss for the ECB leader this Thursday.
Yeah, although I can't imagine she can back away very easily, because she already has weighed into the politics. So at this point, does she double down on that? Does she justify it? Or does she explain how that folds into monetary policy and why that's relevant to her job?
And she's weighed into the politics in so many different ways. It was with France 24. It was with fireside chats at Davos. It was on large panels where she said Europe needs to go on the attack. But I think at some point a journalist does need to ask, is it appropriate? Would you see Jay Powell answering a question at a press conference about Emmanuel Macron or Olaf Scholz?
Or even at home, Donald Trump. Well, just avoid it like the plague. We should send Mike McKee to Frankfurt this week on Thursday.
He'll still be last.
Get McKee to answer. Yeah,
he'll still have the last question, 100%.
Let's turn to your top stories. Under Savannah's this morning, United Airlines reporting better than expected earnings, but saying it expects to lose money as a result of the Boeing 737 MAX 9 grounding. CEO Scott Kirby venting his frustrations over Boeing management and its handling of the situation, even taking the issue to Transportation Secretary Pete Buttigieg. Where is Pete Buttigieg on this story?
Well, Pete Buttigieg is basically saying that they've conveyed to Boeing how they feel, and they want to make sure that they're getting answers. But, you know, the fact that they're airing frustrations to the White House, what is the White House supposed to do in this instance? They say they're monitoring it, but this really isn't a decision for the West Wing. The FAA needs to go through their process.
I gotta say, I was really scared of flying as a kid. And then I started to fly a lot, and then it didn't really matter because it was always gonna be safe. It's very disconcerting to see burning planes and to have this as a concern, even if it's not justified. Flying is still very safe. It's safer than driving a car or walking across the street. I get it. But, sure, you know, there is this sort of like, why do we have to worry about this too?
Look, stories will spook you. Remember TK talked about the turbulence that he experienced on a flight, and he said he looked behind him and he said that a woman was stuck to the ceiling.
Do you believe that?
Not lying. I'm flying back from Zurich, and I'm standing up, and we hit a little bit of turbulence, and I look up at the ceiling.
You're looking for the woman on the top of the ceiling.
And I go back to my seat. Let's turn to this story. New Hampshire voters casting their ballots in the GOP primary between Donald Trump and Nikki Haley. Anti-Trump Republicans looking to rally behind Haley in what might be the last chance to avoid a Trump-Biden rematch. Haley will look ahead to her home state of South Carolina next month if she can pull off an upset. It's unthinkable AMH, that we're talking about this ending before she even gets to home state?
What she's trying to do is bring out the independents who don't want a rematch, like the majority of Americans don't want a rematch of Trump versus Biden. And what Haley says constantly is, look at how I poll versus the former president against Biden. I am leading him 17-20% in a general election. At the same time, it looks like the Republicans are going to go with the incumbent in the primary, which is Donald Trump.
Which we're all really excited about. You said that you were excited about this this campaign. I think that maybe you'll have to give us some of your excitement, because I think a lot of us are a little bit frustrated about, just this sort of divergence between what people want and what they're getting, and it seems like there's nothing that anyone can do.
Totally. Politics worldwide. Politics
100%
worldwide.
Put it very well.
I see it across the board. I want to get to this from Goldman. The chief economist, Jan Hatzius, speaking to Bloomberg, weighing in on the Fed's tightrope.
The Fed is on its way to achieving the soft landing. Obviously, no guarantees, but I like what I'm seeing.
That was Jan Hatzius at Goldman, sticking with his base case for a March rate cut. The cues: a still resilient labour market, consumer prices, and comments from Chairman Powell about cutting before inflation returns to 2%. Here's another man who thinks you might get a March rate cut. This from Mike Gapin of Bank of America with the following quote: look for a reversal of December's strength in January. Consumer spending may be healthy, but it's not surging or slumping. And we don't think the recent report that we got for retail sales, says much about the Fed's ability to cut rates beginning in March, as we expect. Michael Gapin joins us around a table. Morning, Mike.
Good morning.
March rate cuts, even with that data last week.
Yeah, we think the retail sales data was really influenced by the seasonals, right? The pulling forward of consumer spending into October and November, and the difficulty with the seasonals adjusting for it. So we think it's more noise than signal, and it'll reverse in January.
What else is telling you that, given the fact that all the other economic data has also come in better than expected?
Well, I think in this case, we can point to seasonals being, about 2.2 percentage points more favorable this December than they were last December. So it should kind of wipe out any underlying signal. But beyond that, it's really what gets them to cut in March is the inflation data. That even if the activity side of the economy is doing well, as it is, it's really the deceleration in inflation and the fact that we're 6 or 7 months with annualized core PCE running at 2% or less. So as we roll into the March meeting, I think they get gradually more confident about the trajectory.
A March rate cut, and yet do you still lean into, or I know that you don't lean into this idea of 6 rate cuts, that you see something more like 4 or maybe
early
even,
but gradual,
right.
Yes, so 4 for this year.
How do they communicate what their goal is, what their sort of terminal rate is? We heard Bill Gross yesterday, the famed bond investor, say they're basically pinpointing this, and I'm paraphrasing. They're basically, throwing a dart at a wall because they don't have a sense of what that neutral rate is. So how do you get a handle on what they're going to be looking for and how they're going to be signaling?
Well, you never truly know where the neutral rate is, right? And that shouldn't stop you from making decisions that you think are the right policy decisions. So I think what they will communicate is that we're on track for achieving 2%, and to avoid policy from getting too tight, we're going to follow inflation down. Doesn't mean we're easing. We're not easing in response to a recession. We're normalizing the policy stance, preserving some policy rate tightness, and guiding inflation lower. It's a little tricky because we've never done this before, but I think they can do it.
Bob Diamond sat in your chair yesterday, and he said the bar is much higher as they come down than it was as they were hiking rates. Do you agree with that?
Meaning that the closer you get to where you think neutral is, you should be a little more conservative? Yeah, I think that's right. But I think you heard that through Governor Waller's comments, right? That we should go gradual. It's going to allow us to be methodical and evaluate things as we go along. This isn't recession, cut early, cut fast, cut deep. This is move gradually and methodically, and yes, you'll have to find your way as you get towards the end.
If they're going in March, wouldn't you expect them to tee that up next week?
Not entirely. I think that they'll move to a more kind of balanced language, right? They'll remove, we think, the upside bias to the policy rate path and talk about future adjustments to the policy rate. So it'll be more two-sided. I think that's about all they can do. So remember, they see effectively 3 more inflation reports. They see the one this week, the one for February, and they'll get CPI and PPI heading into the March meeting. So they'll have the clean read. So there's a lot of data that could still move it.
Neil Dutch of Renaissance Macro agrees with you that this is the direction of travel. You heard something similar from Jan Hatzius of Goldman Sachs as well. I give you another view from Marko Klanovic over at JP Morgan, who just looks to the tension emerging in the Red Sea at the moment and the prospect that we get a pickup, a reacceleration in goods inflation. Again, what would you say to that?
Certainly possible, but when we look at the data about where the U.S. gets its trade flows and its goods imports from, not a lot goes through the Red Sea, and we think that type of impact could be pretty minimal.
I've read report after report about a reacceleration in housing markets, especially as rates come down, a reacceleration in a whole host of businesses in response to the expected rate cuts coming this year. Are we not talking anymore about the fact that the market's already priced in the rate cuts for the Fed, and so basically we've already done it?
Well, that's right. So the Fed's just going to be essentially validating at least some of what markets are pricing in. And yes, there's a risk that they've shifted too early in this direction, and later in the year, the easing in financial conditions will cause things to be more robust than they want. But I think on net, we're pretty comfortable with saying the inflation data tells them they should be easing. We think that happens in March, and they, and risks are balanced around that.
On a scale from 1% to 100%, how high is your conviction about a soft landing? Why are you laughing at me? It's true.
88.2.
We get that sometimes.
60, 65%.
Really?
Yeah.
How much has that increased over the past couple of months?
Well, in the last couple of months, I'd say it's been about the same. I mean, really, the change for us was last summer, right? When we were one of the mild recession camp people, but the rebound in the supply side, the return of the labor force in large numbers really changed the scenario for us.
Just how weak is the labour market right now? I get so many conflicting messages about that. I think we sit around this table, we look at claims 187, which is remarkable. I've lost count of the amount of months we've stayed below 4% on unemployment, and yet we get a couple of people coming on the programme saying there's weakness emerging here. Do you see the same thing?
I think you can point to weakness in the narrowness of employment gains, right? Virtually all private sector employment is still coming from these catch-up sectors, the high-touch, face-to-face, leisure, hospitality, education, and health. So I think the numbers are private payrolls have averaged 134,000 per month over the last 6 months. 127 of that come from these two sectors. So employment growth in the rest of the private sector is basically flat, right? So the risk is if that catch-up effect fades much more quickly than we all think, does private employment slow down to zero? Do we get that recession risk? Or has the Fed shifted its tune early enough, the rest of the economy gets supported into the second half of the year, gains in employment in those sectors come back?
Is that what's driving this decision ultimately for the March cut, in your mind? Or is the disinflationary trends that have emerged, are they enough? Is that sufficient?
I think that's sufficient, but a little
rally in medical device sales and pharma revenue. J&J is narrowing its focus on high-margin ventures ahead of an expected drop-off in sales for popular drug Stelara. Cheaper alternatives are expected to hit the U.S. market early next year. TKO Group appoints actor and professional wrestler Dwayne Johnson to its board of directors effective today. The owner of WWE says in a statement that it has also entered into a services and merchandising agreement with Johnson that provides for his promotional and licensing services. Shares of TKO Group are soaring in pre-market trading on the back of the news that Netflix bought rights to its show, Raw. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, will the Fed begin to signal cuts?
I would stop quantitative tightening. I think that's just not a correct philosophy and policy at this point in time.
That's next on the program. You're watching Bloomberg Surveillance.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things we have this great connection about the love for baseball, and the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I'll go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Bloomberg has enhanced search on the terminal. to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg.
Live from New York City, equities right now positive by 0.2% on the S&P 500. The opening bell is just around the corner with yields higher by 2 basis points on the 10-year, 412.05. Under surveillance this morning, all eyes on Fed cuts.
I would stop quantitative tightening. I think that's just not a correct philosophy and policy at this point in time to continue to tighten quantitatively. They should leave the reserve balance around $7 trillion and just see what happens going forward.
PIMCO's Bill Gross weighing in on the Fed, the former PIMCO chief, weighing in on what the Federal Reserve will do next. JP Morgan's Priya Misra seconding the motion, writing, "We think that the Fed will taper QT in the next few months. The Fed is trying to finesse the lowest level of reserves to prevent a situation similar to the repo spike Lisa in 2019.
I'm very curious about what's going to happen with the balance sheet. Instead, the conversation's been entirely dominated by when the Fed's going to cut their rates the first time. And I got to say, a big amount of dissent between whether it matters, whether it's March or June. Deutsche Bank's Jim Reed writing, quote, in response to some of the rally that we've seen in equities, the chink in the armor at the moment is rate expectations. Indeed, futures are now pricing in just a 42% chance of a Fed rate cut by March, which is a big shift from the end of 2023 when a cut by March was fully priced in. John, does it matter if it's March or if it's May or if it's June, if the direction is known? You get different answers from different people.
I'm not going to answer that. Priya Misra is portfolio manager at JP Morgan Asset Management. Priya, does it matter?
I don't think so. I mean, if you're trading the March Fed fund contracts, it does matter.
Of course.
If you're trading the 2-year or the 10-year or equities or any asset class, what matters is the end point. How much are they cutting for what is the reason that they're cutting? Are they trying to normalize? Are they actually trying to ease policy? I mean, I would argue the market's pricing in these rate cuts, and whether they start in March or May or June, if they're going to cut all the way to 3.25, I would argue they can actually cut lower than that. You know, they think that long-term rates in a soft landing scenario is closer to 2.5. I would say 2.5 to 3%. Then that is still normalizing policy. That's actually good for risk assets. It means bond yields have some more room to decline. If the economy turns and now they are cutting fast and they're cutting below that 2.5 level, then you've got to be really nervous around risk assets.
All right, and we'll get into exactly what could trigger that. But I am curious, one thing that people do say to me, the reason why March matters is because of the political backdrop. And they say there's no way that the Fed's going to want to be aggressively cutting right ahead of the election. It's going to be tricky. It's going to complicate things. So why not front load it and get ahead of it? Do you buy that?
I don't. I think the Fed has enough things to focus on. I think politics, it's difficult. They are going to get, dragged into the entire political debate. But I would argue they have a framework. They've got a dual mandate. Inflation is allowing them to cut. I mean, we're going to get inflation numbers. The 3-month, 6-month moving averages are running below 2%. That is their target. So what we're hearing from the Fed is, well, we can start. I think they can be slow. The earlier they start, and that's still a big question. I'm not convinced that they'll get enough. Let's see, the revisions will come out. I love Governor Waller brought up revisions and I know you'll be looking at it. For bond geeks, we look at revisions because the market always reacts to that the initial number. Let's look at revisions. If the inflation picture is still weak, if we're still seeing immaculate disinflation, the inflation backdrop is allowing the Fed to cut. And I think they start, whatever happens with politics, I think at least start the normalizing though I'm sure they'll be dragged in, but I think it really doesn't.
Is it hope or is it conviction? What do you think?
Which one is it? What you think they should do or what they will do?
It's always tricky. We all have to think about what they will do, and I think they're trying so hard to keep the soft landing going. I think what inflation's allowed them, I've always felt soft landing, it's rare historically. I felt it's a very narrow path. I think the Fed has looked at that path, seen inflation, and said, let's broaden it out. Let's start, cutting rates. Let's taper QT. I think that's very interesting. They're trying to reduce the level of restrictiveness in the economy to allow that soft landing to last. Whether they can do it, whether there's no non-linear effect that actually results in a recession, I think that's still an open question.
Let's get to the bond market call. 10-year right now, 4.12. We caught up in the last few months and you reduced some of your long duration exposure around 380. We're back at about 4.12. I think you were looking for 4.20 before you started buying again and going long. Is that right?
It is, but what's 8 basis points among friends?
Well, you tell me. Are we in no man's land or not?
I would argue, I think we're going to be in a 375 to 4.25 type range. So I think as you start getting to that 420, 425, I think adding some duration, particularly we've added to risk. And I would argue with the inflation backdrop, with the Fed saying that, hey, we can actually start to normalize, correlations between duration and risk assets are going to come back. We haven't had that correlation in a long time. But I would argue that that's what allows us to actually start to add some duration. In case the economy worsens, that duration hedge will come back. And then, we talk about fundamentals, but I think what's changed in the last few weeks for me is I look at technicals. Look at all the investment grade supply that's actually come into the market, all got taken down well. I think investors have been structurally underweight fixed income. As they're coming back, that $6 trillion sitting in money market funds starts to come into bond funds. That can mean even 412 is not a bad level. Maybe don't put all of it in, but start adding to duration. Anything above 4%, I think, is attractive.
When you talk about risk, are you talking about duration, or are you going full bull and going into high yield bonds?
We're in a soft landing right now. We're looking at the data, and the data looks strong. I mean, I think the economy is normalizing, and so I would say even high yield investment grade, the high quality high yield, I think is attractive. Securitized credit, investment grade credit. I think you just have to do a lot of credit work because there's going to be zombie companies in there. It's hard. Make sure you don't own any of that, or at least try. But I would say spreads look attractive.
When was the last time you were this bullish?
Well, bullish risk assets, it's been a while. I would say because the Fed was raising rates significantly, and the Fed, I think, took that opportunity faster than I thought. I mean, in September, they were talking about higher for longer. And I was thinking, there's no way they're cutting rates until the end of 24. They've opened that path. So I guess I'm more bullish risk than I remember for a long, long time, or since real rates went into positive territory.
Something you said just a moment ago jumped out for me. You said something like, we're in a soft landing right now. The right now piece of it. I remember when you were talking about a hard landing. When you say right now, do you mean like a period of time, a moment, but ultimately at the end of the year, we're looking at something else?
I think there's a chance of that something else. And it's not 5% that the market's pricing in. I think the market is pricing in very low chance of a hard landing. 35%, 40% chance of hard landing, I think is still there. Because when you look at the details of the data, it's not all that robust. You start looking at the narrowness of the labor market, or the fact that, there's pockets of weakness elsewhere. So I would say there is a chance that things slow down, or the Fed doesn't cut fast enough, or they continue QT long enough. And that's when that chance of something going wrong, I think we always have to be positioned for that. And I think it's there by year end.
It sounds like you believe there's a window here to be constructive risk. And what I would like to know from your perspective is what it looks like when the window starts to close. What are you looking out for?
So beyond data, I would be looking at, again, every revision, the details of every economic data. But beyond the economic data, what I'm looking at is real rates. If real rates, 10-year real rates get back to 2% or higher, that's restrictive. I mean, I know we talk about financial conditions all the time. Financial conditions are restrictive. That window starts to close if they stay restrictive or they become more restrictive. And that's going to depend on data. It's going to depend on what the Fed does. And that's when I'll get nervous that they did not cut rates fast enough, and that restrictiveness is going to show up. Remember, we've had that lock-in effect. The lags are much longer because we all locked in a low level of rate, corporates, households. When that lock-in effect starts to go away and you have to start paying those real rates, that's when.
Well, Lisa can enjoy a 2% mortgage for another 25 years or something like
that's
that.
right,
She's going
correct.
to keep reminding us about it.
All the
Priya,
time.
it's good to see you. Priya
great.
Mishra of JP Morgan Asset Management. Are you happy that Priya put a number on things for you?
I actually think it's hilarious because we now have consensus. We've got JP Morgan and we've got Bank of America. 35% chance things go bad, 65% chance that we've got rainbows and unicorns.
True, it's true. But in the meantime, the window's there. Buy risk.
Exactly.
Buy credit.
And the most bullish on risk that Priya's been for a while. That's interesting to me.
Didn't get to politics though, did we?
Oh,
no.
Well.
For good reason, probably. New Hampshire, the primaries, that's what's to watch a little bit later on this evening. The team's going to guide you through that at 8 p.m. Eastern Time on Bloomberg Television tomorrow. Absolutely stacked program on Bloomberg Surveillance. We'll catch up with the IBM Vice Chair Gary Cohn, former House Speaker Kevin McCarthy, Kathy Jones from Charles Schwab, Citi's Andrew Hollenhorst. All of that still to come as we count you down to the opening bell. 34 minutes to go. Equity futures just about positive on the S&P. From New York City this morning, good morning. This was Bloomberg Surveillance.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember.
From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Farrow. Equity markets showing a peak of green. They're holding on for the hero that is earnings from tech. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up in the show, it starts slow with another record as the earnings season starts to heat up. China considers a $278 billion rescue package, and it's GOP showdown in New Hampshire with Trump versus Haley. We begin with a big issue, attention turning to tech.
It's all about earnings at the moment. Tech earnings are supposed to be up in double digits.
The tech sector has done very well last year.
We had the big AI boom pushing through earnings for tech stocks.
What drove the market last year was that magnificent 7.
Tech stocks have been able to deliver.
The bar has been set incredibly high.
Expectations could be on the higher end, and that could be a risk.
I am broadly positive.
Earnings
expectation is likely to be justified.
I still think they're going to be one of the fastest growing sectors.
The enthusiasm for the Magnificent Seven will continue.
The equity market is looking at the strength of earnings.
Earnings deliver, markets can move a bit higher.
This is the most important earnings slate that we've had in a very long time.
Joining me now is Morgan Stanley's Mike Zazas and Winnie Sazer from Credit Insights. Tech. There's a frenzy. There really is quite a frenzy in this market this morning, and we are now down to depending on tech to deliver. When you look at risk, to me it feels like a coiled spring. Michael, you would say we've got to thread the needle and there's very little room for error. With that in mind, how important is the earnings in this part of the risk cycle?
I think it's important, and listen, I think this is a really interesting time to be looking at tech and considering AI in the sense that there's about $6 trillion of market cap added last year for what we call kind of AI enablers, and this is a year where kind of like the rubber should meet the road, and we should be able to see if a lot of those use cases are actually going to add value. I mean, as it pertains to equity market impacts, though, and translating it back into fixed income, I mean, listen, I think the equity market is already kind of priced in a lot of ways for this idea of a soft landing, fixed income less so. And so to us incrementally, right, unless AI is driving this really major uplift, then I think a lot of the incremental opportunity or sort of more reliable return opportunity is going to be in fixed income this year.
Okay, the flow from money markets into fixed income, and that is a narrative that's been building. Winnie, good morning to you. You said a good chunk of the performance has already been brought forward. It's been brought forward in the equity market, but it's been brought forward in the fixed income market. Are we richly priced on credit?
Good morning to you as well, and thanks for having me. So we're actually at our year-end targets for both U.S. investment grade and high yield, and we really got there pretty much by the end of 2023. So we pulled forward performance by almost a full year. Now, it is quite typical to see a lot of performance realized in the first few months of the year, and I think especially true this year when you do have a back half with political risk and the Fed risk and all sorts of different storms possibly brewing. I think that the expectation was to have a pretty good January, February, and then people sitting on their hands a bit more. But the fact that we realized so much performance really in November, December of last year has left a lot of people wondering kind of where do we go from here? And we've actually been recommending to clients that we should take a pause and be tactically a bit more cautious despite having a long-term constructive view on credit.
Okay, so I like that phrase, tactically cautious. Now, this is going to come down to the differential between what the market is pricing in cuts and what the Fed actually delivers. Let's just listen to Jan Hatzius. He weighed in on this very subject overnight in Hong Kong.
The Fed is on its way to achieving the soft landing. Obviously, no guarantees, but I like what I'm seeing. A March cut or cuts in general over the next few months under our forecast are somewhat optional. The economy is holding up, pretty well. We don't think it's essential that they cut here, but it would be consistent with the signaling.
So let's turn that into what you both think. Michael, one narrative that's been building through the morning with me, I had Alberto Gallo at the start of the day at 5 a.m. He said, you're going to get a couple of insurance cuts, but you're not going to get dramatic slowdown cuts, and the window closes because of politics after Labor Day. Do you think we're going to get insurance cuts or slowdown cuts? Michael?
Well, listen, I mean, our economists think you're not going to get the first cut until June, but I think for fixed income investors, you got to take a step back here. And the big picture is that inflation's coming down, the Fed, the ECB, the BOE, they're all sort of skewed towards cutting. Really, the question is kind of when and what pace. That should be a really good backdrop for fixed income investors in general, and then developed market government bonds in particular. And here, I think we flagged at the beginning of the year, we thought there was 10% plus total returns in that cohort. We've gotten a lot of them already, but we think there's probably still 5 to 7% to go. And just based on the idea that soft landing or not, if central banks are cutting, maybe things in the short term aren't priced exactly the right way you want in terms of the probability of cuts in the near term. But over the next 6 to 12 months, we think the direction is pretty clear towards lower yields.
Okay, I mean, 5, 6, 7% is still worth taking. Winnie, let's just close it off with you before I pivot to China. These rate cuts delayed to as late as June in your mind and then compressed?
So we had been saying to expect the first rate cut in March, which back in October felt really risky. And then we were very surprised to see how materially the Fed pivot in messaging was in December. And I think that this really highlights one of the problems the Fed has with communications, in that the market is going to very aggressively price in whatever policy path they're expecting, even if the Fed is not going to go that quickly. And that does result in a loosening of financial conditions, which we've seen materialize over the past few weeks. And so now we're thinking that actually the probability of a March cut might be a little bit lower than what the market is pricing in. And we think that especially the upcoming January meeting, the messaging might be a little bit more hawkish, a little bit more disappointing, because in aggregate, at the headline level, the economic data have not really supported a potential easing. But we do think a Fed cut comes in the first half of this year.
They don't want to lose the win that they've got from Waller and Bostic from last week. Let's turn our attention to China. Bloomberg learning that Beijing is considering $278 billion package to stabilize its slumping equity market. Bloomberg's Mike McKee joins me now. So this is not a bazooka for the economy. This is a floor for equities, Mike.
Well, at least that's what they're hoping. You're talking about the U.S. cutting rates. In China, they have moved monetary policy, but it hasn't moved confidence. A picture is worth 1,000 words, or maybe a couple of trillion yuan here. You can see the CSI 300 and the Hang Seng. They have lost 10% and almost 7% on the year, and that just builds on what they lost last year. It's been an elevator down for the Chinese stock market. So people familiar are telling Bloomberg News that the Communist Party at least, is planning a rescue package to put a floor under the market, 2 trillion yuan, as you said, $278 billion, from offshore state-owned enterprises, from cash they're keeping out of the country. Brad Setzer asks, why is that money out of the country? They really want to bring it back, which is an interesting unanswered question. But they would bring it back, buying onshore stocks through the Hong Kong exchange link. There is also a plan to spend 300 billion yuan, $42 billion from local funds. They'd buy onshore stocks through government investment funds, primarily through Shanghai. We also heard that regulators are guiding, in their words, insurance companies against short sales. Is this going to work? Well, along with Brad Sett, there are a number of other people who think this is a questionable program. They point to 2015 when the Chinese government put money into the stock market. And as you can see there, stocks went up for a little bit. And then as soon as the stimulus went away, stocks went way down. They introduced a circuit breaker, that's the blue line there, and that really killed the market. So given the fact that the U.S. now has sanctions on China, along with other countries, and the fact that the Chinese economy is really struggling, the housing market's in bad shape, a lot of questions about whether this is actually going to do anything, maybe provide a floor, but maybe not.
Okay, well, that is the debate for the equity market and the economy. Mike McKee with the very latest on China. Mike and Winnie, look, it's very interesting. I arrive in this country and we don't talk about China at all. The time zone shifts dramatically from the Middle East, London to the Middle East to here. It doesn't matter till it matters. This morning it kind of matters. $300 billion to put a floor under the equity market, but it's not a bazooka for growth. What are the ramifications of what China does, the world's second biggest economy, to investing here, Mike?
Yeah, I mean, listen, I think the mechanics of this particular move is still something that we're sorting through, but I think the big picture is that China growth is slowing. China's sort of shifted its economic strategy anyway, in a way that you wouldn't necessarily rely on it to be this major engine of global growth anyway. And it's all part of a confluence of factors that's helping to drive down the pace of inflation in developed markets, and I think feeds right back into the idea that we could be getting good returns, i.e. lower yields over time this year through most of the developed market world and government bonds.
And for you, Winnie, I had one guest this morning that says China's uninvestable from a government bond point of view. I don't think anybody out there, given the injuries they've had from equities to bonds, would disagree. Extrapolate the move this morning for global disinflation.
So I think for global disinflation, we can, pretty confidently say that the Chinese government is trying to kickstart their economy. They have had a lot of stimulative efforts in place. The big difference is that these stimulative efforts that we've seen over the past, call it 6 months, have not jump-started things like they have historically. And I think that that ultimately comes back down to the property markets. And when we're thinking about the path for global inflation, commodities are going to be a pretty key aspect, and one that the Fed has less control over because there are supply-side constraints there. So if we still have China kind of trundling along, not necessarily really ramping back up in growth, I do think that that is pretty positive for the commodity side of things in terms of not going too overheated.
You see, China does matter. It can make it into the conversation. It is relevant. Michael Cesar, Winnie Caesar, stay with me. We've got more work to do. Let's look at what's going on under the hood. Abigail Doolittle is with me for the movers and shakers. Abby.
Well, we are potentially looking at a fourth up day for the S&P 500 in a row. Very small gain at this point, but we have one big gainer into that open. United Airlines up 6.6%, heading to, I believe, its best day of the year right now. They beat earnings by nearly 20%. Revenues they beat too. They offered new guidance that wasn't the massive profit slash that we saw out of Delta. In addition, growth is just right, not strong enough that it can actually support fare hikes. D.R. Horton, not so much, down nearly 5%. They posted weaker than expected new home orders. A look forward into what people want to do in terms of buying homes, but also look back on those 8% mortgages. The stock was up over 65% over the last year, just not good enough, those results. So, and then GE down 2.3%, profits for this quarter of 60 to 65 cents, shy of the 70-cent estimate. All of this, of course, ahead of the breakup. They are spinning out their aerospace and energy businesses later this year in a bid for a multi-year turnaround.
Okay, Abby, thank you very much. Come fly the friendly skies. Obviously, it worked for United. Coming up, GOP presidential hopeful Nikki Haley is getting ready for her make or break moment in New Hampshire.
Republicans have lost the last 7 out of 8 popular votes for president. That is nothing to be proud of. We should want to win the majority of Americans. But the only way we're going to do that is if we elect a new generational conservative leader.
We head to Manchester for the latest. Bloomberg team are on the ground. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Your fixed income fix. Watch Bloomberg Real Yield at its new time, Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
We should want to win the majority of Americans. But the only way we're going to do that is if we elect a new generational conservative leader. I voted for Donald Trump twice. I was proud to serve America in his administration. But rightly or wrongly, chaos follows him. You know I'm right. Chaos follows him.
Showdown time. Donald Trump, Nikki Haley head-to-head in the New Hampshire primaries. Polling showing the former president has a commanding lead over the former UN ambassador. Another blowout win for Trump could all but secure this nomination. To New Hampshire we go. Kayleigh Lyons is on the track. So there's already been a little bit of overnight voting in, what's it called, Little Dixie? I'm learning so much about America, it's killing me. So where do we stand, Kayleigh? Good day.
It's Dixville Notch, Manus. Only 6 votes were cast there, roughly around midnight. All 6 actually went to Nikki Haley, but we're not entirely sure that that's how the rest of the votes in the Granite State are going to go today. Yes, this is a 2-person race, what Nikki Haley says she wanted all along. The question is going to be, come tomorrow morning, once all the votes are in, will it still be a 2-person race? Because Haley has said New Hampshire, given the large chunk of independent, undeclared voters here, is her best chance to eat into Trump's lead as the frontrunner and presumptive Republican nominee. The thing is, she and her team, her surrogates, like Governor Chris Sununu, have suggested all she really needs is a strong second. The polls suggest that that second may not actually be that strong. Suffolk University and the Boston Globe have a daily tracking poll running. Today, Trump is ahead by 22 points, with 60% saying they will vote for him. Only 38% will vote for Haley. Now, a large part of this may come down to turnout. The Secretary of State here in New Hampshire, David Scanlon, has said more than 320,000 voters could show up to the polls today, which would be a record for a Republican primary here in the Granite State. And it will likely be a higher turnout vote that strategists think could make more so a break in Haley's favor. Yes, it is warmer here in New Hampshire than it was in Iowa by about 45 degrees. That could play a factor, but it's not just weather. It also is enthusiasm. And data consistently shows that Trump supporters are far more enthusiastic, more energized to get out and vote for him than Haley's supporters are for her. So we have to consider that. And one final note I would say, Manus, it isn't just the Republicans having a primary today. It's Democratic primary day as well. Incumbent President Joe Biden is not on the ballot, as he and the DNC have said South Carolina should be the first primary because of its more diverse voter base. So there is a write-in campaign instead for the president and other candidates in the mix as well, like Congressman Dean Phillips, the Democrat from Minnesota. So there is a question as well to what kind of showing President Biden could put up here in the Granite State today, and whether or not that number, if it is low, suggests that he is a weaker candidate as we move forward to what very well could be a general election matchup between him and former President Trump. Manus.
Yeah, he's banking on the write-ins, and of course, the Right Honourable from Minnesota could indeed scoop up a few votes and sort of rock the Democratic cradle. Kayleigh, thank you very much. Kayleigh Lyons in Manchester. Mike Zazas and Winnie Sager are my guests. So here we are. We're careering, in theory, towards a Trump on the ticket. That's sort of what all the polling is showing. But what was pointed out to me this morning, which was interesting, it's perhaps more important, we're going to deal with the fiscal side. You're both bond at heart, bond and credit investors. So the risk is, the political risk is, not just Trump in the White House, but a Republican Congress, which has a much bigger impact on the fiscal scenario and therefore the bond flow. Mike.
Yeah, so listen, I think it's important not just to know which party takes control of the White House, but also Congress, right? And if you have a scenario where one party is in complete control, that opens up a lot of fiscal expansion opportunities. In a scenario where Republicans are in complete control, you could pencil in a decent amount of fiscal expansion by extending expiring Tax Cuts and Jobs Act provisions. That said, there's cross currents even in that situation, because there's potential tariff policies on the table. Candidate Trump's talking about a blanket 10% tariff, and there's uncertainty around what it would mean for international commitments for the U.S. That could snarl supply chains and the like. So I think you could put some expansion on the table in that hypothetical. I don't think it's necessarily a straight line to make some strong conclusions yet anyway about what it would mean for the bond market.
Okay, so look, it's still a bit early, and I grant you, you're dealing with slightly more known quantities, both in terms of rhetoric, policy style, and ability to execute. Winnie, here we are, we're at 412. We could have a very different narrative coming from the Trump campaign if the polls are to be believed between now and the end of the year. Would that shake the bond market, or is it just too soon to get the bond market really to blink? Do we just trade 375 to 325?
So we do think that there is some near-term risk to the upside, especially in long-term yields, if the fiscal conversation becomes front and center again, which it clearly was last early August when there was the Fitch rating downgrade. We had Treasury refunding announcements much punchier than expectations. So if we have a return to expecting perhaps a Republican sweep or a Trump as president again, then you might see some loss of confidence again around the fiscal side of things, especially for investors outside of the US. And one of the big differences in the potential Trump presidential campaign this year versus in the past is that yields are objectively higher around the globe, which means that non-US investors have opportunities to put capital to work at pretty enticing yields not in US Treasuries. And that is something that we see as a meaningful short-term risk, as many clients are positioned for yields to remain pretty range-bound in the near term.
The one thing I want to close off with both of you, Winnie, let's start with you, which is we simply are not really pricing any kind of a hard landing. There is this narrative, soft landing, 1995, no landing, etc. But hard landing, we just finished a conversation with JP Morgan Asset Management. They're ascribing 35% probability to a hard landing. Is it in your cast of characters, or what percentage would you ascribe to a hard landing? Winnie?
So we have a hard landing in the 15 to 20% probability range. But I think even more importantly is we have the potential for a stagflation type outcome also in our cast of characters. And that to us is the worst case scenario for fixed income or for US corporate credit, because that means that yields are going to be maybe even higher for even longer than people are anticipating. Right. And you're going to see this rolling default cycle that's going to be much more challenging to manage and much more difficult for the Fed to manage. They don't have necessarily a playbook for stagflation. They do have one for a hard landing.
Okay, an interesting differential. Mike, let's just finish it off, wrap it up in 40 seconds. The hard landing stat for you.
Yeah, I mean, soft landing is our base case, but hard landing is probably the next most likely. I mean, right now in our base case, we like developed market government bonds and corporate credit. If hard landing looks like it'd be more likely, we'd obviously leaning more on government bonds than on credit. Even there, we think IG corporate credit in the U.S. would probably still do pretty well because you're coming in with relatively clean balance sheets. But certainly, we'd want to avoid high yield more in that scenario.
Okay. Team, thank you very much. That's Mike Zizas and Winnie Caesar on their calls for the markets. And I'll give you a slew of morning calls in just a moment.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
just holding on to a slightly broader bid to the Russell 2000. The rest of the markets holding on for Netflix and the other tech numbers to come in. Let me give you some of your morning calls that are going to set the agenda. We've got the analyst recommendations. This is what we've got for you. First up, JP Morgan cutting his recommendation on Coinbase to underweight. Analysts say the enthusiasm around crypto ETFs could deflate. Next up, Chevron getting a downgrade by TD Cowen to market perform. The analyst says that the Hess deal may not contribute to the oil giant's bottom line until 2027. And finally, satellite radio company SiriusXM is getting a downgrade from Wells Fargo to underweight. The analysts see weak subscription revenue. Coming up on the show, Calvin C. of BNP Paribas discusses why he believes the market is pricing an overly optimistic earnings season.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities
could face bigger challenges. Listens next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond. Equity markets quite literally holding on by their fingernails for the hero that are the technology earnings. Look at that. See who's opening the opening bell? There you go. That mattered probably more to the sentiment. There you go, Mr. Johnson. Equity markets are, as I say, trying to trade high. You got these bond markets debating where they go next in terms of yield. We'll see what Netflix delivers in numbers. They're already doing deals this morning. We'll talk more about that in a moment. Euro dollar, that is down by 1/8 of 1%. 10-year yield straight flat at 4.1320. A lot of the juice is already in the equity market and in the bond markets. That is the narrative from our panel of guests this morning. Oil drops by 0.7 of 1%, 74.25. There is one stock to watch at the open. United, the airline, beating on expectations for this year, the outlook, despite the hurdles being presented to them by Boeing. Come fly the friendly skies with Abigail Doolittle and United.
I plan to be flying those friendly skies in the not-so-distant future, Manus. Love to travel. As far as shares of United, they're flying high, too. Excuse the pun. The best day since April of last year. A relief rally in some ways because Delta, not so long ago, in terms of their quarter, they guided down relative to profits. That's the opposite of what United did, as you just mentioned. So the quarter that just was, they put up earnings of $2 per share, 20% or thereabouts better. They beat on revenues. Relative to the guidance, they gave new guidance for 2024 of $9 per share to $11 per share. The estimate, the consensus at $9.45. So the midpoint above that. Some analysts saying it's very important, especially given all the problems with the MAX planes, the fact that they were able to maintain and give guidance that could potentially be better than what the street was looking for, that is really very positive. In general, analysts are positive, saying that this was a strong beat for the end of the year, that guidance seems very solid, and that one analyst in particular over at Citi, Stephen Trent, saying that this is further evidence that U.S. network airlines, the big airlines, have traded places with the discount carriers. As for the stock performance coming into this, United Airlines underperforming two of those other big airlines, down about 21% relative to Delta, down 5%, and American Airlines down 16%. But probably now, after today's big performance, at least right now, Manus, it's probably trading a little bit more even to American Airlines, but still some work to do to fly positive on the year.
Okay, Abby, thank you very much. Let's stick on the earnings one. Johnson & Johnson beat most of the estimates with medical device sales and pharma revenue driving the profit. Katie Greifeld is with me now. Johnson & Johnson, steams ahead. What drove the numbers?
Well, there was actually a lot of good news here. You take a look at the shares, you're not necessarily seeing that. But to get specific, fourth quarter earnings, they actually beat most expectations. That was thanks in a big part to medical device sales and better than expected pharma revenue. Two areas with plenty of high margin opportunities, which bodes well for Johnson & Johnson. CFO John Wolk also said that, Joe Wolk rather, he said that, quote, large M&A does not scare us, and that the company is considering pharma deals. So a lot of movement going on at J&J. Shares currently lower, though, as you can see, by about 2%. We'll see how long that lasts, given if you take a look at the sell side, pretty positive on this report. Citi, for example, saying that the strength in the firm's medical devices unit bodes well for peers. You also have JP Morgan saying that the numbers highlight healthy underlying trends for J&J's business. So stay tuned, but currently down by more than 2%.
Okay, we'll keep an eye on that. Katie, thank you very much. And tune in to our interview with the CFO at 10:40 a.m. Eastern Time. What level of AI overlay can he put into Johnson & Johnson? That might help the stock. Different earnings outcome for Dr. Horton, the home builder, reporting weaker than expected quarterly orders amid high rates. Natalia Kanijevic joins me now with more detail, down 4.43%, so a bit of pressure there.
That's right, Manus. So quarterly earnings came up 35%. That sounds year over year. That sounds like a lot, but it was an easy comparison, and the number came below expectations. EPS also disappointed, but at the same time, the U.S. home builder was very optimistic about this upcoming selling season this spring. They also slightly increased forecast revenue for the full year. So 2023 was a very challenging year for the U.S. housing markets. Rates were elevated, and it's pretty much understandable because who wants to buy a new house when mortgage rate was about 8%, and if you bought it, especially during the pandemic, when rates were at 2%. So now mortgage rates are coming down. Big U.S. home builders are using incentives. They have an opportunity to provide lower rates for customers, somewhere around 5%, and it helps them a lot. So as mortgage rates moving down, we see this increase in U.S. home building sentiment. In January, it spiked by the most in nearly a year, and we see that it's still actually slightly below pre-pandemic levels. During the earnings call, the company also said that they will continue using incentives, and they are ready to reduce prices for homes and also reduce square footage when necessary, just to boost sales.
There you go, trying to get those houses off their lot. Of course, it's D.R. Horton, not Dr. Horton. Irish humor doesn't go a long way in New York, does it? Natalia, thank you very much. Another earnings number for us to keep an eye on. Procter & Gamble, the consumer goods company, missing the estimates as volume continues to slip. So where was the slippage? Simone Foxman can give us the details. Stock 5.5% higher, Simone, so talk us through it.
Yeah, there were some mixed messages here, but the analyst class clearly reading the positive ones, and that's why we're seeing shares up well over 5% this morning. This is the maker of Bounty paper towels, Downy fabric softener. Saw that organic revenue miss. That was where we saw some pressure. Beauty sales up 1%. Everyone had expected that they would be up 3.8%. Baby and family care also falling short of estimates, and the company complaining of a slower than expected recovery in China. All of this weighing on overall sales. Overall net sales, $21.4 billion. The expectation had been $21.6. That said, the positivity here, all because the profits were really okay. They were still able to boost prices 4% year-on-year. Margins significantly better than expected, and their profit outlook for the full year ending June 30, that was also on the high end of estimates. They'd been talking about 6 to 9% growth, now saying they're going to see 8 to 9% EPS growth, even though their sales are going to be on the lower side of expectations. For retailers broadly, we're seeing them try to play off a wary consumer that's overall spending less with juicing their margins and overall delivering higher profits. That was what's happening here. Bloomberg Intelligence saying this profit beat, easing commodity costs and improved volume trends, all of those things are underpinning their confidence on the company achieving its guidance. Citi also saying these were solid results, and that optimism being reflected in early trading, Menace.
Okay, Simone, thank you very much, Simone Foxman there. Let's turn to our guest now. It is Calvin C. at BNP Paribas weighing in on earnings. He gave it to another newspaper, but we won't hold that against him. Here we go. The market is looking for a re-acceleration in earnings growth to 12% this year from 3% last year, and this looks a little bit too optimistic in the environment where we expect growth to slow. Calvin, good morning to you. So I've been saying all morning, I'm sort of channeling a song from the 1980s. We're holding on for the hero that is the earnings, specifically from tech, really to give us a little bit more alpha. You are doubtful. Why are you committing this crime of doubt?
Sure, thanks for having me, Manus. Our main message is that we think the markets are too optimistic for this year. If we look across asset classes, including in equities, it looks like the markets are perfectly priced for a soft landing in the United States. We expect that landing to be a bit bumpier. We're expecting growth to essentially be flat in the first quarter, looking for a small contraction in the second quarter, and that is an environment that we think is going to be quite difficult for the markets to meet their earnings expectations. As you said, the markets are looking for an acceleration of earnings this year from 3% to 12%, which we find hard to see in an environment where growth is slowing.
Now, you did say to another newspaper, despite all the enthusiasm that we've seen in stocks right now, we're inclined to go the other way. Now, what does that mean? Does that mean de-risk? Does it mean short? Does it mean hesitancy? Translate for me.
Sure, there are different ways that we like protecting the downside. One is options at the moment are quite cheap, so we like buying downside protection. As well, there are certain pockets of the market we think that make overwriting strategies look quite attractive. In other words, if you cannot go short the market, you could own your stocks, but at the same time sell topside calls, and that allows you to collect some premium, earn some income, while at the same time being in the market. Again, as we don't expect the markets to trade significantly higher from here, we think those kinds of strategies make a lot of sense for investors who need to stay invested in the market.
And to a certain extent, we're having a debate this morning and every morning about the timing and the type of rate cuts that come. So this morning so far, we're going to get insurance rate cuts from the Fed, and maybe that's 2 cuts, and then the window closes as of Labor Day for them. Does that sound about a base case for you? Because you're quite bearish in terms of the number of cuts and the timing.
That does not really resonate with our own views. Our own view is that the Fed starts its cutting cycle in May of this year. They cut 25 basis points at that meeting, and they cut 25 basis points for every meeting for the rest of the year. So we're looking for 150 basis points of cuts this year. And while that may seem a lot, the Fed is only forecasting 3 rate cuts for this year. We don't think it's that extreme, especially when we're thinking about policy in real terms rather than nominal terms. We're expecting quite significant deceleration in inflation this year. And as that occurs, the rate cutting regime that we envision basically keeps real rates steady. In other words, it's not adding a ton of accommodation into the market, but if the Fed didn't cut consistently, we think, in the back half of this year, it would push real rates higher, which would actually tighten conditions, which is something that the Fed probably wants to avoid in a scenario, again, where we see growth slowing down this year.
So if that's your view in terms of rate cuts beginning in May, we go one each meeting then, how do you think this plays out then for the curve? Because that is a series of rate cuts, not predicated on any massive implosion in growth, I'm presuming. It's the fabled soft landing and behavior in inflation. How do you see the curve reflecting then?
Sure. So for this year, we don't think the markets are that mispriced. We're forecasting 150 basis points of cuts. The markets are forecasting about 135, so we're not too far off. Where I think the best opportunity on the curve lies is not for 2024 pricing, but where the markets have priced for the endpoint, in other words, the terminal level of cutting. And what's really interesting to me is that the markets have pulled forward rate cuts quite aggressively over the last few months into this year, but that endpoint has been pretty steady, and we're currently around 3.35%, and we've been hovering in that 3.25 to 3.5 range for quite some time. That's another sign to me in the rates market that the markets are, again, very optimistic, because the Fed's view of where neutral policy setting is, rates that are neither restrictive nor easy, is at 2.5%. So the market's expecting the Fed to end close to 3.5, suggests that in the rates market as well, the markets are looking for a very soft landing. We expect that landing to be a little bumpier than the markets expect, which is why our own forecast is that the Fed ends its cutting cycle at 2.75%. Therefore, because of that, we like positioning in the belly of the curve, and we like steepeners looking for 5-year to outperform the 10-year.
Yeah, and this is a building narrative, not just now, but certainly before Christmas and onwards, which has been, you know, go for the belly of the curve. I look at risk, and to a certain extent, there's this a phrase that we had over Christmas time, this weaponized FOMO. And to a certain extent, I want to get a sense from you. Do you think that these markets look as if they're being careless or reckless in any way in how they're pricing equity risk?
I wouldn't say the markets are careless or reckless. What I would say is that the markets are optimistic, and the markets are very positioned in a way that is quite different from last year, where last year positioning was light, earnings expectations were weaker, especially as everyone was looking for a recession, while at the same time protection was well bid. This year, basically everything's flipped on its head, where positioning is now long. We think that earnings expectations are too lofty, while at the same time, that reach for protection isn't there. So an indicator that we look at is skew in the S&P 500, the cost of puts relative to calls. That's at a historically low level, suggesting that investors are not looking for that protection. And this overly optimistic market environment, we think, is one that suggests room for correction lower.
Okay, and that, if we scale back a little bit on that, maybe all those hedges, as you say, will work if you write the calls out of the money calls and maybe pick up a little bit of cheap volatility. Calvin, let's see how it plays out. Calvin C., BNP Paribas, my guest this morning on markets. Netflix will deliver their numbers, kicking off the big tech earnings after the close.
They will still continue to deliver growth, of course, supported by these structural tailwind, that is artificial intelligence.
Big tech better deliver on Bloomberg.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
Not just last year, but in the past 5 years, right? The compounded annual growth rates of these mega cap tech companies has been great, ranging from 15% to even 30% for the EPS growth. So I do think that this earnings expectation is likely to be justified. They will still continue to deliver growth, of course, supported by these structural tailwind that is artificial intelligence.
Jenna Mew there of RBC Brewin Dolphin giving her outlook for the tech earnings season that's really going to kick into high gear. Netflix brings the bacon home today, getting a boost after announcing they're going to pair up with WWE for the first big move into live events. Netflix are paying $5 billion for the exclusive rights to wrestling content, and there's potentially more good news on the way. The analysts expect Netflix to beat its own forecast for subscriber growth when they report after the bell. Geetha Raghunathan joins me now. So we caught up a little bit earlier, and you've got some pretty punchy numbers penciled in for subscriber growth. Let's start there.
Yeah, absolutely. So, expectations going into the fourth quarter, Manus, are pretty high. This is a seasonally strong quarter, good, solid content lineup. And of course, they have their two big initiatives, which have been in play through most of this year. One is, of course, the new advertising tier, which is, much more economically priced. And the other one is the password sharing crackdown. And both of those initiatives are not only expected to yield new subscribers, but going into 2024, it's going to be about how they play up the revenue reacceleration story. And you brought up an excellent point with the Raw deal, because that really speaks to their scale or the ambitions that they have for their advertising business.
Live wrestling. There was a huge cheer went up in the newsroom every 2 weeks there. That's it. Wrestling reigns in the New York newsroom. Geetha, thank you very much, Geetha Raghunathan there. Bloomberg Intelligence will bring you those Netflix numbers. Of course, and let's stick with the deal, the WWE. Nick Khan, WWE president, joins us in the next hour. So that's going to be a fascinating insight. Ed Ludlow is standing by in terms of what else we've got in the pipeline of Bloomberg technology. So I said it at 9 a.m. I'll say it again. We are holding on for the hero, Ed, that is technology.
Yeah, I think that the big theme for the earnings season is that the Magnificent Seven are still going to account for the large bulk of EPS growth for the S&P 500, for example. But this week, we kind of start in earnest. The chip sector is really important to watch. Texas Instruments is a maker of very basic chips that go into very many end markets, but they also are seeing shrinking bottom line because Many customers have been working through a build-up in inventories. And then you look at Intel later in the week, the first time that they're due to report both revenue and profit growth in the post-pandemic era. But the thing they both have in common is the outlook for 2024. TSMC's capital spending plans for this year, they're the biggest contract manufacturer of chips, made us confident. And then go back to the Magnificent Seven. Tesla is first up this week, record quarterly sales expected. But again, look to the bottom line. That seems to be where we're going to be most focused because they had to heavily discount and incentivize in the final 3 months of the year, with analysts expecting a drop in EPS, of about 39%. And Tesla has this target of 50% annual growth, which means that they should guide us towards 2.7 million EVs in 2024. The street thinks they'll guide to 2.2. But the broader story with EVs has been that we will still have growth in global sales this year, just not the growth we expected. And of course, being the market incumbent and the leading pure play in EV, Tesla is the best barometer of that. So buckle up, Manus. It's an exciting week. They let me out of my box, and I'll do my thing.
And you'll do it very well. Ed, thank you very much. Bloomberg Technologies, Ed Ludlow there. Calvin C. is with me, BNP Paribas, for his final thought. There is this view, buy strong tech with balance sheets. They earn money in a rising rate environment. Here we are going into a cutting rate environment. Will that embolden the growth to value narrative?
Thanks, Manus. A lot of the equity rally that we've seen over the last few months has in large part been because of the macro environment. And what I mean by that is we've seen a large rally in rates over the last few months. And that large rally in rates has meant essentially that these earnings in the equities market has been discounted back at a lower level. What's notable, though, is the driver of the rates rally. And the driver of the rates rally has largely been improving inflation. So inflation lower, rates lower, the equity markets love that. Going forward, however, we think that significantly lower rates from here, the driver is going to change. And with the markets already pricing the Fed to cut essentially at 25 basis points a meeting for the year, for rates to go lower, we need the markets to be pricing 50 basis points a meeting. And we think a necessary prerequisite for the markets to get there is that growth needs to weaken quite significantly. So the main message here is that lower rates from here, we don't think is necessarily going to be that equity market supportive because the driver is likely to change.
Okay, let's see how the year pans out. It's still fresh in the year. Nobody really has that crystal ball. Calvin, thank you very much, Calvin C. On the markets right here on Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
bid for breadth this morning. Russell up 0.5%. 80% of the companies that have reported in America for the fourth quarter, they've beaten in terms of profits. That's the note hot off the UBS scribe from Salita Marcelli. Let me get you up to date with your trading diary. This is what you're going to watch for the rest of the week. Today, it is all about politics, New Hampshire primary, plus Netflix. We've banged that drum several times. We'll get those numbers. Wednesday, it is more tech earnings, Tesla and IBM. What are the price cuts of Tesla? Thursday, it is macro monetary policy. ECB is on the block, and we will get a read on the growth story in the United States for the GDP. American Express hits the tape on Friday. Equity markets at the moment are bid. This is about banking on earnings from Netflix, from Tesla. Equity markets are bid up. That was countdown to the open. Thanks for joining us on Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Paul Sweeney and Alex Steele with you here, Bloomberg Intelligence, for a Tuesday morning. We've kind of got a mixed tape out there. We'll get to that in just a moment. Coming up, we're going to check in with Brooke Sutherland. She's a Bloomberg opinion columnist. She covers the industrial companies. A lot of industrial companies reporting earnings today. Not so great. We'll check in with her. And then we'll speak with Natalie Trevithick. She's head of investment grade credit strategy at Payton and Rigo. Get her market call on the credit space here. And then we're going to touch base with Bloomberg Israel Bureau Chief Ethan Bronner. He's going to join us via Zoom from Israel, get the latest news coming out of Israel. So all that this first hour, lots happening. And let's kick it off here with a Bloomberg Business Flash.
All right, the major averages mixed in the early going. Earnings certainly in the driver's seat today. S&P 500, we have 7 of the 11 major industry groups in the index. They are actually higher. Communication services in the lead. That's where we're going to find shares of Verizon. It reported it's finally adding wireless subscribers. And the biggest drag right now, healthcare. That's where Johnson & Johnson resides. The CFO said pharma sales are going to be lower in the second half of the year. So, where do markets go from here? We put that question to Seema Shah at Principal Global Investors.
We are expecting this to be a fairly strong year for equity markets, but we also anticipate that the beginning of the year could be fairly volatile. Maybe certainly not seeing as strong equity market gains as a full year, but really spreading out to a number of other sectors, other styles as well. So I think it's going to look slightly different to what we saw in 2023, but overall still a positive year.
Yeah, right now the S&P 500 3 points higher, 48.54 on the index, keeps going higher. Nasdaq 100 12 points higher. The Dow Jones Industrial Average 71 points lower. That's at 37,931, and you can almost guess what the worst performing stock in the Dow Jones Industrial Average, 3M, down right now just about 10%. Nora's going to take a deeper dive into that. But we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
John Tucker, thank you so much. We appreciate it. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're streaming live as well. So head over to YouTube and search Bloomberg Radio. And Alex, the story for me, wrestling. Netflix has acquired the exclusive rights to Raw, as well as other programming from World Wrestling Entertainment, marking the streaming service's first big move into live events. And what I learned in the previous 3 hours, one Lise Mateo may have a little bit of a crush on The Rock.
I mean, okay, number one, who doesn't? The Rock is awesome. Number two, but I genuinely don't.
By the way, he was able to copyright The Rock. So
yes.
It's exclusive to him.
As he should, because he's awesome.
Yep.
But what's interesting about this deal is that
missing?
it basically doubles what the WWE is going to be getting from what it's already getting on cable. Like, this is serious money that's being thrown here, and I wonder what Netflix does. Do they raise their prices? What do they do?
Know. I mean, the TKO Group, which owns the wrestling stuff, up 20%. So how about that?
Yeah,
so it's a big move there in that. It's a 16 billion market cap company, go figure. But it's good for those folks right there. Let's bring in Nora Melinda. She covers all the stocks, all the markets here. She joins us here in our Bloomberg Interactive Broker studio. Nora, what are you looking at in the market today?
Well, D.R. Horton, that's a home builder. It reported its first earnings gain in 5 quarters in pre-market trading today, but that wasn't enough to wow investors, as the firm's increase was less than analysts had initially expected. Its volume of orders and backlog also missed consensus estimates as well. That stock is slumping as much as 7.7% for its worst day since November 2020. Barclays analyst Matthew Booley urges investors to use this weakness as a buying opportunity. And Ken Zenner, he's an analyst over at Seaport Research. He's known for correctly calling the sector's performance for the past 2 years, actually downgraded his view on the sector to neutral yesterday, citing return potential for the sector has diminished.
Yeah, and BI talking about how commentary, Drew Redding is awesome. He covers the home builders for Bloomberg Intelligence, and he's saying that it's really about the commentary that's key, because in theory, this is supposed to be a super great space because we need the supply, right? So
and the
it's
stocks
all gonna,
have done well.
Exactly. So it's all going to be about sort of that expectation management, which clearly didn't work so well for this quarter.
Right, and DHI does say that it sees some optimism heading into the spring selling season, and as you all know, home builders, that is their strongest season.
Yeah, I mean, I'm just looking at the mortgage rates, and we're still high. We've come off the highs.
Wait, are you going to refinance yet?
No, it's not. I'm not even remotely close because I have a 6% mortgage. So I need to. I'd love to.
Not bad,
it's not bad relative to historicals, but I mean,
it's me.
You.
I'm the awesome one.
You're the crazy one.
Oh my goodness. 2.75.
2.7.
Nice.
Jealous.
High five.
Giving you money.
3 1/4.
You won.
I mean, literally, I can put my money in like a 3-month T-bill and like easy pay my mortgage for like 6 months.
So,
Everyone's jealous.
Yeah, we need to get a 4 handle before I call my guy.
Well, speaking of something that's not doing well, the worst performing stock in the S&P is 3M. Walk us through why the pain is so much.
Yes, this is another spiraling stock for you today, Alex. One to keep an eye on. 3M forecasts 2024 profits and sales growth that were below Wall Street expectations as it continues to contend with sluggish consumer demand that's weighed on growth for the better part of a year. The cautious outlook was announced as 3M reported adjusting quarterly earnings well above Wall Street expectations, helped by a restructuring push to make the company more streamlined. Those shares are plunging as much as 9.9% for their biggest drop in almost 4 years and making it the biggest weight on the Dow Jones Industrial Average by percentage.
Yeesh.
I mean, I know we're going to talk to Brooke Sutherland a little bit. She covers all these industrial companies here, and also the GE results were a little disappointing too. So it's corporate America.
Yeah.
A little tough out there for them because we've seen PMIs, manufacturing PMIs, actually been negative for many, many months now, in contraction. It's the consumer that's been holding up this economy, but the manufacturing part has definitely been struggling.
But that's why I think 3M is so interesting, because they do lots of stuff.
Yep.
Like they sell things to China, there's the retail spending, like my Post-its, there's industrial demand, and there's electronics. They do so much, and all of it doesn't work right now. And the whole point of a big conglomerate is that if one area stinks, then the other area can make up for it, and that's just not where 3M
Didn't
is.
we debunk that a long time ago?
This is the theory, man.
Yes.
I am just saying the words for the
I mean,
theory.
think about it. We'll talk to Brooke Sutherland about this, but just think about the last 20 years for GE, what it was and how it's trimmed down to now just going to be two businesses, two separate businesses.
Yeah.
I mean,
it is kind of amazing, isn't it?
And again, I was there when Jack Welch and John Tucker was there. John Welch built all this stuff up, and then he leaves, and then it's just been 20 years of slowly dismantling GE, and now you're left with a couple of businesses.
It is a moment.
Yeah,
it is definitely a moment.
So, and Karen Uberhardt from Bloomberg Intelligence has been there through the whole thing. So
there you go.
Exactly.
Verizon you're also looking at, though.
Yes, going to give you a bright spot here today. Verizon is jumping as much as 5.3% for its biggest one-day gain since October. It's one of the biggest gainers in the S&P 500. The company reported that it added the most mobile customers in 2 years. This really marks a turnaround for the company.
Yeah, this is a tough business, man. Everywhere you look, the mobile business, just for telephones, incredibly competitive. And you think about their commercial business, providing broadband to small and mid-sized and corporate businesses, also brutally competitive.
So where's the growth here? Is it just like not losing growth?
It's not, and that's why this is basically a utility. I think some of these things, there's just no real growth because it's everywhere you go is competitive. The cable companies are right there in your backyard for your broadband business, and now they're into the phone business. So it's just a very competitive business, and it comes down to just managing your capital structure and being efficient with your cash.
You know who likes Verizon?
Who likes Verizon?
Bill Gross.
Bill Gross?
He likes Verizon because he's basically just wanting to clip all the dividends.
You interviewed Bill Gross yesterday.
I did, and he specifically mentioned Verizon.
Did he really?
Yeah.
You don't hear that very often.
Exactly. Like not a sexy stock, like not a lot of growth, but it's all about that dividend payout. So
all right,
there's
Nora,
that.
thanks so much for joining us. Nora Melinda, she covers all the equities for us. Let's check in with Brooke Sutherland. Why? Well, she's very nice. We like talking to Brooke, and she's super duper smart, and she really covers all of these industrial companies well. And there's a lot of stuff to talk about here. So Brooke Sutherland, she writes for Bloomberg Opinion. She's based up in Boston. Hey, Brooke, I don't know where you want to go here. We've got the 3M issue. We got the GE earnings. Let's start with those companies, which are, right in your bailiwick in terms of industrial America. What do we take away here?
Sure. I mean, I think there are two different stories here. So, I mean, GE sits primarily its crown jewel is the aerospace business, which will stand alone come April once it completes sort of that final piece of its slow-moving breakup. This is a very strong corner of the industrial market, particularly for companies like GE that provide maintenance services, repairs. That business has been booming because we've had so many issues with Boeing and Airbus in terms of being able to deliver jets. So it's kept airlines flying older planes for longer. Older planes need more shop visits. They need more repairs. And so companies like GE have just been really growing like crazy there. And that looks set to continue given Boeing's continued challenges and then also the recall of the geared turbofan jet engines, which is impacting a big portion of the Airbus A320 fleet. And so that business is really doing quite well. And I think GE is just kind of chugging along here. I think the stock reaction that you're seeing reflects the fact that this company, the shares have really just taken off like a rocket ship over the past 12 months on enthusiasm about this breakup. And maybe, investors got a little bit ahead of themselves in terms of the forecast. But this is also a company that has a history of setting the bar at a beatable level under Larry Culp. At 3M, it's a completely different story. They play more in sort of the shorter cycle industrial markets, places with quick sales turnarounds. And so they've really been hit hard by slowdowns in electronics and in China as well. And, that sort of general inventory destocking phenomenon that's haunted much of the industrial sector over the course of the back half of 2023. And I think, as you look at the forecast that they gave for this year, there's nothing heroic here. We're talking about pretty pedestrian sales growth going forward. And I think, there was some hope that maybe we might start to see some green shoots, that, this corner of the industrial world might start to turn around if for no other reason than, the ISM has been in contraction territory for 14 months now, which is the longest streak since the dot-com bubble burst. And at some point that has to end, but it doesn't appear that we've reached that point just yet.
Talking about 3M before and just talking about, hey, wasn't this the whole point of a conglomerate that like you have all these different parts, you have industrial demand, you have retail demand, you have China demand, you have electronics demand, and then that's going to spare you all the pain, but it seems like everything is not doing well.
3M always makes the argument that their businesses stick together because of material science. When you think about, they sell automotive adhesives and then also Post-its, but at the end of the day, it's still an adhesive and there's a lot of overlap there. But where that is really breaking down is that they were supposed to have this, superhuman R&D engine that would just keep churning out better and better products and help push the growth of the company along, and we're just not seeing that in the results. And the company has been in restructuring mode for years now, quite frankly, and then also dealing with the very serious legal liabilities related to PFAS and military earplugs. And so it's a company that is trying really hard to reinvent itself and get back to focusing on actually making industrial products, but that's just not the story right now.
So Larry Culp, is he taking a victory lap here? Because he's really done a good job, it seems like, just looking at the stock.
Yeah, he should be. This was certainly not an easy task that he inherited. It was some pretty dark days when he took over as CEO of GE. And I think there are a lot of lessons here from what he's been able to do as we think about what Boeing needs to do to right the ship over there. There was a lot of shared executives between those two companies, and I think some similarities between their two cultures, and GE has done sort of a really top to bottom overhaul of the way that it operates. And that extends, not just to the boardroom, but to the factory floor. And Larry Culp's been very hands-on, and he's a big believer in lean manufacturing. And that is a philosophy that is rooted first and foremost in safety and quality and on-time deliveries, which are things that, Boeing really could use some lessons on.
Yeah, said so nicely because it's brilliant. So I'm looking through the different areas. We talked a lot about aerospace. For GE, I'm going to be interested in the energy part, and that's what really the spinoff is going to be. I have to say, though, not terrible. Like the renewable energy revenue up 23%, power revenue up 15%. There was still an operating loss, though, in renewable energy. Where's the weakest link there?
Yeah, no, it's definitely not terrible. And this business has come a really long way. And, you know, I think it's gotten to the point where it is at least stable, and that it's realistic to have a conversation about what this looks like on its own, which was certainly not the case for a very long time. They're still struggling a bit in offshore, but they, you know, have been able to eke out some profits in onshore and in grid, which is really, you know, helping to put this business in a much stronger place. So they're not out of the woods completely just yet, but they've really come a long way. And to be talking about positive free cash flow, I mean, that blows my mind a little bit as I remember the dark old days when we were coming out of the, you know, disastrous Alstom acquisition, and this business was just on the gas turbine side was just bleeding money. And so, you know, this has really been a stark turnaround, and the business is in a much better position, especially when you think about Siemens Energy, which is probably the closest peer, and just all of the issues that they have had, which also stems from quality control. And I do not think it is a coincidence that GE under Larry Culp, with all of his focus on lean manufacturing, has avoided the major quality control lapses that we've seen at Siemens Energy, at RTX, at Boeing. I think the company is just a lot more on top of it, and that's a reflection of his approach.
So it's wind. So it's all about energy. It's the big wind turbines.
Yeah.
Often somewhere off of New Jersey, I think they were supposed to be, and then Orsted didn't like that so much.
Oh, that's the proposal. I believe it's gone through. They're still doing, I think, environmental impacts.
No, but the companies, they want more money because prices have gone up so much, and the contract isn't giving them the money, and so they're kind of pulling out and writing down their stuff.
Seeing those big turbines off my deck.
We got bigger issues in New Jersey. Hey, Brooke, let's switch gears a little bit about Boeing. I'm seeing that recently the United Airlines chief executive Scott Kirby criticized Boeing on Tuesday, saying he was disappointed with what he called the plane maker's sluggish response to the grounding of MAX 9 aircraft. What's the latest from our good friends at Boeing?
I mean, the latest is that MAX 9 variant that was involved in the Alaska Airlines incident remains on the ground, and the FAA is being very thorough. They did complete sort of the first round of inspections on those 40 initial jets, and we're downloading that data to see if that process was what it needed to be to get those jets back up into the air. But I mean, I think the frustration among Boeing customers is palpable, not just from United, but we've also heard comments from Ryanair and a couple other customers, because this is just not the first time that we've had manufacturing issues out of Boeing, nor is it the first time that deliveries have been delayed, or, you know, a plane that Boeing had promised on a certain timeline gets significantly delayed. And I think if you're an airline customer, you just have to be frustrated, and I think that's just what we're seeing right now.
Yeah, it really is amazing. And the question is, where do you go? It's a duopoly here, so I'm not sure where you go.
Exactly.
So, all right, Brooke, thanks so much for joining us. Brooke Sutherland, she's a Bloomberg Opinion columnist. She covers all the industrial